Studies are going great, life is going okay, direct tax is being revised till you hit the chapter of PGBP. You see it from the book, it feels very big. See it from ICF material, it feels never ending. And hence, this revision video on this chapter called PGBP is absolutely important and will help you revise as easily as possible and as soon as possible, guys. So, here it is. Before you go to PGBP, let's see where does PGBP come in the exam. Question number 1, where they will give you a person called Mr. A. They will tell you that he is into some business or he is into some profession, and they'll tell you to calculate his total income and his tax liability. This is where you will first hit PGBP, and the way to do it is not read all the chapters, the entire chapter. The way to do is see how this asked in the exam. So PGBP has 5 parts. The first part is incomes, which will, I think, very easy to identify. You'll not have a problem. Example, if I take lectures, my lecture income will go under PGBP. If I have a restaurant, my food sale will go under PGBP. Very easy to understand the income part. Be careful about 1, 2 things there. Partner, if they get salary and interest from the partnership firm, that will go to PGBP. No, business contracts, if you get some money, that will go to PGBP. And any gift or any benefit which you get in relation to business or profession, any amount, any gift, it will also go to PGBP. So those are the incomes. Very easy to understand those income parts. So the first part is incomes, which you will have no problem with, and you will be able to revise it very easily. Next, in fact, you don't have to revise it also. This income part is done. Next comes deductions. So the thumb rule is that in deductions under PGBP, if there is any expense which is connected to your business or profession, you can take it as a deduction. Example, in my business, I pay rent, I pay electricity bill, I pay salary, I have depreciation. Can I take all the deductions? Yes. Now let's go into details and let's talk about some of the deductions. First, anything like rent, etc. If you see, you can take a deduction. Any repairs, etc. You see, you can take a deduction. Any insurance, etc., which you see, business insurance, you can take a deduction. Now let's go to some peculiar deductions. One is called scientific research. Either I can do scientific research in-house or outside. Outside means I can donate money. When I donate money, I get a deduction. In-house, when I spend money on scientific research expenditure, then from the year I start my business, even 3 years back, if I've done some scientific research, raw material and salary deduction I will still get in this year. And if I buy any capital asset, example microscope, then I will get the 100% deduction, that is for scientific research. But remember, you need to use it for scientific research. If I sell that microscope, they will reverse up to the cost. Example, the microscope is for 5 lakh. They will first give me deduction of 5 lakh. But if I sell that microscope, up to 5 lakh will be reversed in PGBP. Above that will be reversed in capital gain. Next, if I have any specified business, example, I start a 100-bed hospital. There's a list called super fast bike, can cover 3 hospitals, 3 workshops, 3 institutions. Remember that list. Go through that list of specified businesses. If the exam will tell you it's a specified business, then in that case, again, you will get a 100% deduction of any capital expense, of course, except land. Here also except land and except goodwill. Now, what is the other benefit of specified business? 100% reduction of any capital expense. Even if I have bought the capital asset before and now I'm introducing into my business, that's called capitalizing, I will still get 100% reduction. But here you have to be careful of a couple of things, guys. 8 land. You have to use the asset for 8 years. If in 8 years you sell it, again reversal will happen. The losses cannot be set off with against other profits. You'll have to set it off only against specified business. You need to be auditable, and N is the plant and machinery that you buy should be new plant and machinery. Up to 20% second hand is okay, but only in specified business. And if you transfer the asset from specified business to non-specified business within 8 years, then whatever benefit we got 100% reduction, they will be reversing it, but they will give you depreciation at least. Next, if you have any preliminary expenditure, example, before starting the business, if I incur any preliminary expenditure, the government gives me a reduction of that, but in 5 parts. I call it as a pastry, not as a cake. So I'll get it over 5 parts. Example, if my preliminary expenditure is 10 lakh, I will get 2 lakh every year over 5 years. Now there are some conditions to it. First, this expense should be a revenue expense. Second, it should, if it's project firm, example, project report, feasibility study, engineering study, market survey, these 4 expenses either have to be done in-house or through an approved source only. And last is, this is a limit of preliminary expenditure. It is 5% of your cost of project. So if my cost of project is 1 crore, 5% of that is 5 lakh only. So even if I spend 10 lakh, I will get a deduction only of 5 lakh. And if you're a company, then 5% of cost of project or 5% of capital employed, whichever is higher. Capital employed means your equity, your preference, your debt and your loans. If it's foreign loans, then only if it's for more than 7 years. Next, if you pay some expense which is VRS expense, voluntary retirement scheme expense, then from the year you pay, you will get the deduction, but again in 5 parts, not in one go. From the year of payment, you will divide the expenditure will be given in 5 different parts. Next, we'll talk about some residual case, section 37, where if any expense you feel is connected to your business, take a deduction here. If there is no specific section, you can take it under section 37. Remember, sections are not so important right now in PGBP. I'll teach you the important sections at the end of this video. Next, except two deductions you can't take. One is I, illegal expenditures, bad in law, secret commission you cannot take. And one is C, IC is a shortcut. C is for CSR. If any expenses of CSR, sorry, you cannot take a deduction because CSR was told to you to do by Income Companies Act. This is the Income Tax Act. Next, there are some more expenses. Let's talk about that. If in my business I have some insurance, I will get a deduction of that. If I pay bonus and commission to my employees, I can take deduction for that. If I pay interest on my business loans, I can take deduction for that, but not interest on interest, not penalties, and not interest on income tax. Next, if I have any zero coupon bonds, that means I've issued some bonds at 100 rupees and I'm going to repay them 120. So the 20 is an expense. I will get a deduction over the period of the bonds. Next, if I have any bad debt, not provision of bad debt, provisions are basically not allowed only in PGBP. Only if it's an actual bad debt, you will get a deduction. But if you get a recovery, then you will be taxed again. Example, I had an income of 1 crore. I wanted a bad debt of 5 lakh. The government will tax me only on 95 lakh. But if I get recovery, that will be taxed in PGBP back again. But if I want a deduction of bad debt of 5 lakh, and the government gives me a deduction only of 3 lakh, that means they've already taxed me on 2 lakh. So any recovery up to 2 lakh will not be taxed again. This is bad debt. Next, we can see that if you contribute to the employees provident fund or to the employees national pension scheme or to the employees gratuity fund, then you will get a deduction. For this, you need to pay the amounts by June, that is by July, October, November, you'll pay and you will get the deduction. And if it's the employees money which you are paying, this is not your contribution, employees contribution, then that has to be paid by the next month, otherwise you will not get the deduction. All right, we move ahead to the next point. Any STT and CTT that you pay, you will get a deduction. Any family planning expense, although it's not connected to your business, still scientific research and family planning expense, even if it's not connected to your business, you will still get deduction. But family planning revenue expense full, but capital expense you will get only in 5 parts over 5 different years. Anything else? So these are the expenses. Besides this, if you see any other expense, please happily take a deduction, but only and only if it's connected to your business and profession. These are your deductions. Next, we go to disallowances. These are those expenses which you have incurred, but the government sees some problem here and the government says, listen, yeah, we don't like these deductions, we will not allow them as a deduction. The shortcut is poor politician pays cash and UPI. So this is it. Let's see what is the shortcut. Poor is, the spelling is here, PORR. Any personal expense will be disallowed. Any payment that you make outside India on which you should have deducted TDS and paid to the government. If you don't deduct TDS and pay to the government, you have to deduct it during this previous year and pay it by John. If you do that, great. Otherwise, 100% will be disallowed. If you are paying to a resident without deducting and paying TDS, then 30% will be disallowed. If you are paying to a relative or specified person something excessive or unreasonable, excessive income is not a problem, but if you are paying something excessive, but to relatives or specified persons, who are they? The clock, spouse, brother, sisters, parents, grandparents, children, grandchildren, and specified persons means anyone whom I have substantial interest in. In that case, if you are paying someone excessive, that will be disallowed. Remember, sister disallowed. Sister-in-law, if you pay excessive, no problem at all. Next, politician. If you put any ad in a political magazine, political channel, that will be disallowed. Poor politician pays cash. Any cash more than 10,000 per person per day, and if you're paying to a GTI, you have a higher limit of 35,000 per person per day. Up to that is allowed. Above that is fully disallowed. Any unapproved funds like your PF, etc., if they're unapproved, you will not get deduction. Any provisions, you will not get deduction, and any income tax when you pay will not get a deduction. Income tax, let's quickly discuss. Income tax when paid, no deduction. Income tax refund, no income. Interest on income tax, no deduction. So what is the concept here? Income tax should be ignored, except if on the refund, if you earn interest, that interest part which you earn, that will go under IFOS. This is a disallowances. Remember the sections we will talk about later, but these are the disallowances. Now, cash, in cash, although 10,000 and 35,000 is the limit, there are some exceptions to it. There is a rule called Rule 6DD, where there are some exceptions called A, B, C, D, E. If you're paying to an agriculturalist, fisherman, animal husbandry, dairy farmer directly, then in that case, the 10,000 limit does not apply. If you're paying to someone who does not have banking facility, if you're paying to a cottage industry which does not even use power, if you're paying to an employee's salary who's out of office for more than 15 days, but you have deducted TDS, and if you're paying an employee retirement benefit on the retirement up to 50,000, in that case, that 10,000 limit will not apply. This is Rule 6DD. These are the deductions and disallowances. Now we go to the next part. So we are done with incomes, we're done with deductions, we're done with disallowances. Now, guys, 44A, arrange accounts, and 44B, AB, audit the books. Arrange accounts is very simple. If you're a businessman, you're a sizable businessman, if your turnover is more than a certain limit, 1.5 lakh, and your sales is more than 10 lakh, please maintain books of accounts. Honestly, not important. These limits you have to check in the last 3 years. If any year you cross this limit, maintain books of accounts. Not important, will not come in the exam. So 44A, you can happily leave. But 44AB, absolutely important, audit the books. In India, if you're a big fish, that means in a businessman, if your turnover is more than 50 lakh, and as a professional, if your turnover is more than 50 lakh, and as a businessman, if your turnover is more than 1 crore rupees, then please go to a CA because you will be subject to audit. Of course, you'll get a higher due date. Till October, you can file your return. Now, these limits have been increased. 1 crore limit for businessmen has increased to 10 crore, but subject to a condition. Both your cash payment divided by total payment should be up to 5%, and your cash receipts divided by total receipts should also be up to 5%. If they're up to 5%, that means you are using less cash. Then we'll give you a higher limit up to 10 crore. You don't have to go for audit. That's great. And for professional, 50 lakh has been increased to 75 lakh. This is the due date, or this is the concept of audit, section 44AB. That is also done. Let's go to the next and the last part here, which is basically presumptive taxation. In the exam, just like when you have Google Maps, you have two routes to go to a particular place. Same way in the exam or in real life, you have two ways. For small businessmen only, they have two routes. One is a regular scheme where they maintain books of accounts and they say their profit is this much, or they can follow presumptive taxation where you tell the government your turnover and they assume the profit to be some percentage. The section is 44AD, assume deductions. You tell the government your turnover and they assume your profit to be 6% or 8%. 8% if it's cash, 6% if the money has come in the bank account. Now, after the 6 and 8%, you cannot take any deduction under PGBP. What is the benefit? This is great. This presumptive taxation is great because there is a shortcut called ARP. You don't need to go for audit. You don't need to maintain your accounts, and you have to show fixed profits. Profits can be higher, but you cannot show it lower. If you show it lower, then you'll have to go for accounts and audit. Also, guys, not everyone can go for presumptive taxation. Only people who are right residents, individual HUF partnership firms, and if your turnover is up to 2 crore, this turnover limit has been increased to 3 crore, but provided your cash receipts divided by total turnover is up to 5%. Here is only one condition. Next, 44 ADA, same assume deductions again, but this one is for professionals, ADA is for businessmen. For professionals, the percentage is 50% of your turnover. Your turnover should be maximum 50 lakh. Here also it's right. Same concept, same thing, except here HUF is not qualified to be a part of 44 ADA. And again, you can show higher profits, you cannot show lower. And 44A, always on the expressway. This is presumptive taxation for those people who are engaged in the business of GTA, goods transport agent. In that case, every truck will be assuming to earn a profit of 7,500 per month or part of the month. So, example, if I buy a truck today, 15th of March, it will be assumed that this truck, just 1 second. It will be assumed that this truck earns a profit margin of at least 7,500 per month or part of the month. Example, if I buy a truck today, 15 March, then even for half a month, it will take 7,500. But if it's a large truck, heavy vehicle, more than 12 tons, exact 12 tons, light and medium. If it's more than 12 tons, then if it's 13 ton, 14 ton, 15 ton, then per ton 1,000 rupees. So not 7,500. If it's 13 ton, then 13,000. 14 ton, 14,000. This is how you need to calculate. Here it is applicable to everyone. No right. Only thing your number of trucks should be up to 10 trucks. If you're more than 10 trucks, then you cannot fall under presumptive taxation. Now some additional points. The first additional points is there are types of businesses. Generally, there are three types of businesses. We've discussed this in Sourabh chapter already. There is normal business called non-speculative business. Then there is speculative business where you're buying and selling without taking delivery. And there is specified business where you're having a basically 100-bed hospital, etc. And derivatives, if it comes, it will come into normal business or non-speculative business. Next, closing stock. If you have closing stock which is wrong, then your profit will be wrong. And closing stock is linked to profit directly. So if your closing stock by mistake is higher, your profit by mistake is higher, so you'll have to reduce your profit. Same thing, opposite of the opening stock. Opening stock will be given the opposite impact. So always work first on closing stock and then work on opening stock. Next, there is something called 43CA. Let's discuss that next. If you are a businessman and you're selling land, building, apartments, flats, villas, etc., then you've already done this in capital gain. They will compare your sale consideration with stamp duty value and take whichever is higher. Of course, they'll give you a 10% margin. Example, 60 lakh and 70 lakh, they will take 70 lakh. But if it's 60 and 65 lakh, then they will take 60 lakh because it's within the 10% margin. And if there are more than one stamp duty value, you have the same concept. You can take the lower one if it happens to be on the date of agreement. You have to prove that some amount has received by mode other than cash, bearer check or cross check. No CBC allowed there. Next is 43B. Very, very important. There are 5 expenses called merit. These 5 expenses, the government says, listen, even if you follow accrual system of accounting, you will get this deduction only when you pay any tax to the government. GST, municipal tax, but income tax, of course, you don't get a deduction even if you pay. Any interest to banks, NBFCs, financial institutions, NV amounts to the railways, and to the employees 3 amounts BPL, their bonus, their provident fund contribution, etc., and their leave salary. Then what is MSME? To MSME also you need to pay, but here guys, it's even a stricter deadline. You cannot pay even till June. So these you can pay till June, but for MSME, MSME is micro, small and medium enterprises. Not for medium enterprise, only for micro and small. That is for very tiny entities. You will get the deduction only when you pay within 45 days or the period agreed, whichever is lower. If the period agreed is 32 days, then 32 days. If 52 days, then 45 days. And if there is no agreement, then within 15 days you pay. If you don't pay, you will not get a deduction this year. You will get it in the year next year. That is the year of payment. All right, we go to the next one. We'll keep looking at additional points. The next additional point we can talk about is depreciation. Yes, we've not spoken about depreciation. Guys, depreciation is on all business assets. Any business asset you can get depreciation, third and fourth and whatever business asset you get depreciation as long as there is OP. It is owned by you and it is put to use. Put to use means active use as well as passive use. Depreciation, there are fixed rates of depreciation. First, for land and building, it is 10%, furniture 10%, plant and machinery 15%, and intangible assets 25%. But on land, you don't get depreciation, goodwill, you don't get depreciation. If it's a temporary structure, 40%. If it's a residential building used for business purposes, then it is 5%. Furniture, no problem. Plant and machinery, 15 is the general rate, but if it's computer, 40. If it's pollution control equipment, 40. Anything good for the environment like windmills, etc., 40. Anything that changes often computers, laptops, books, etc., 40. EVs are 40. Car is 15%. If it's a ship, then it's 20%. Aircrafts go fast, so 40%. So these are some of the rates that you have to buy heart and get done with it. When you depreciate, there are two methods of depreciation. In the exam, they will only ask you one, which is WDV. In WDV, you have a family method. That is, you have the same category of assets, same type and same rate. You bundle them and make it one block of asset. All the computers together, all the benches together, all the laptops together. And in that case, you start with the opening balance. If you purchase something, add it to the block. If you sell something, minus it from the block, but don't calculate on sales any profit or loss. And on the final amount, calculate the depreciation. And if the other method is SLM, SLM only power companies can choose, and that too they will not choose, because in SLM you don't have a family method. Each individual asset has to be depreciated, and if you sell the asset, you have to calculate the profit and loss. Profit is called balancing charge, loss is called terminal depreciation. Next, this is depreciation. There is something called additional depreciation. Okay, sorry, half year depreciation. If an asset has been put to use by 3rd October, 2nd October, 1st October, you'll get full year depreciation. But anything after 3rd October, example 4th, 5th, 6th October, if you put to use, not purchase, put to use, then you only half your depreciation this year, next year half. And if there is any SAMR, sale, amalgamation, merger and reorganization, example, an academy gets sold to Byju's, then who will get the depreciation? Both based on number of days. Next, if there are some people in India who get 20% additional depreciation also, who are PM, power and manufacturers, and they only get it not on building, not on furniture, not on intangible asset, but only on plant and machinery. The plant and machinery should be new. The second hand does not work. It should be unboxed in the factory. Only on then. You don't get it on ships and aircraft. You don't get it on motor vehicles. Only on plant and machinery you get 20%. If it's half year, then 10% this year, 10% next year. All right, keep looking at some additional points. This is all depreciation. Whatever you can't minus this year will be carried forward to the next year. That's called unabsorbed depreciation. Actual cost. When you buy an asset, depreciation rate is fixed, but can I manipulate the asset cost? No. The cost of the asset is all the amounts I paid till the asset is put to use. Example, if I buy a machine, the import cost, the transportation cost, the installation cost, everything will go into the balance sheet. On that, I can create depreciation. The day I put to use it, today 15 March, I put to use the asset. From tomorrow onwards, any expense will go to P&L account. And in this case, you have to be careful about three things. If the machine has been bought and you got a subsidy, example 1 crore machine, 10 lakh subsidy, then in the balance sheet will go only 90 lakh. When you import it and you have paid some custom duty and you got a credit back, that means you not spend the money, so that you cannot include in the balance sheet. And last, if you bought the machine on a loan and you're paying interest up to the date of put to use will go to the balance sheet. Interest after the date of put to use will go to the P&L account. There are sums on it. You can have a look at that. This is called cost of asset. This is done. This is done. Preliminary expense is done. DDA, don't do anything, is done. VRS expense, specified business done. These deductions done. Dustbin section done. Merit done. John done. 37 to be politician done. 100% deducted. 30% disallowance done. P interest, yes. As a partner in a partnership firm, can the partnership firm pay you interest? Yes, that will go under PGBP. But how much interest can they pay you? Maximum 12%, and that too if they have profit. What if they pay you more? The excess will be disallowed. We're talking about the partnership firm. And whatever is allowed to the partnership firm, same will be taxed in your hands under PGBP. Now, when you're getting salary, the salary depends on the profits of the partnership firm. So first you have to get the book profit. How do you get the book profit? Take the normal profits minus the interest, but only up to 12%, and get the book profit and split the book profit up to 6 lakh, above 6 lakh. Up to 6 lakh, it is 90%, that is 5 lakh 40,000, and above 6 lakh will be 60%. Take the total, and let's say the total is 7 lakh 80, then to all the partners in the year, you can maximum pay 7 lakh 80,000 only. That's an example, that number If the number is very low, lower than 3 lakh, at least you can pay 3 lakh to all the partners. This salary you can pay only to working partners, interest you can pay to all the partners who have provided you money. Next, guys, excessive payment we've discussed. This is cash disallowance we've already discussed. Provisions we've already discussed. This 43 CA we've already discussed. Deemed income. There are some income which are indirect income. Example, bad debt recovery. Example, that scientific research asset by microscope which you sold. So they will reverse it. Example, any cancellation of liability. All these are indirect incomes and they will be taxed under PGBP. Composite, if you have tea business, coffee business, sugar business, where you grow the tea and you process it. If you just sell the tea leaves, then there's only agriculture income. Otherwise, guys, you'll have to split it. For tea business, 40%. For coffee business, 40. Coffee grown and only grown. Um, Here it is, guys. If it's only grown and cured, then it is only 25%. If you grown, cured, roasted, grounded, flavored, etc., then 40%. And for rubber business, 35%. Maintenance accounts is okay. Audit the books is okay. Presumptive taxation we are done with. That's okay. Guys, this is amazing. We did the entire revision of PGBP in just 20 minutes. That is superb. Now, what you do is you go to your sums, and I'll tell you the top few adjustments that happen. One is depreciation. Either they've forgotten the depreciation or you have to calculate the depreciation. Be careful about that. Second, excessive payment. Excessive income is not the problem. Excessive payment to specified person, that's very common in the exam. Cash payment, very common in the exam. The limits of 10,000, 35,000. Be careful about that. Next, payment without deducting TDS. Very important. Be careful about that as well. Next, any other then some of the questions also say that presumptive taxation. If it's a presumptive taxation, all you have to go is take the sales number and multiply it by 6 and 8% and you'll get the number. This is presumptive taxation. This is your revision video on a chapter which is called PGBP.
In life, there are some small joys which give you small things which give you a lot of joy. Same as this chapter, small chapter, but it'll give you a lot of joy because this chapter is coming in your exam from anywhere between 5 to 8 marks. This is a chapter called Set Off and Carry Forward of Loss. Let's revise this chapter entirely and then over to the sums. You can do the sums after that. So first up, how do you know in the exam there is a chapter Set Off and Carry Forward of Loss? They will not tell you. They will just tell you compute the total income. And in the incomes, you will see that there are some losses. So you need to know that these are the losses which you have to set off. In this chapter, remember the focus should not be on profits, the focus should be on losses. That means you have to ask the loss where all it can go and set it off. If it cannot be set off, then it will be carried forward. That's the concept about this chapter. In the next 10-15 minutes, let's do a quick revision on this chapter called Set Off and Carry Forward of Losses. The first thing, it's like a blood bank. When you require blood, you first go to your family. Here also, when I have a loss, I'll go first within my family or within my head. That's called intra-head adjustment. If family is not enough, then I will go to my 4 neighbors. Here also, each head of income has 4 neighbors. Example, if I'm talking about house property, they have neighbors like salary, PGBP, capital gain and IFOS. So they can knock on any neighbors and they can take blood from them or loss set off from them. And third, if the family also, neighbors also can't help, then you have step number 3. You will go to the next years and stay with your family. Same way, here also you can be carrying forward those losses. So these are the 3 steps in which this chapter has to be done. First, let's talk about the first step. There are 5 heads in the exam. Whichever person they give you, example, they give you a person called Mr. A. Draw a diagram like this in rough and make 5 arrows like this. And first park all the numbers. Don't think about where it can be set off. Just park all the numbers. In salaries, there can never be any loss. So there will be no intra-head adjustment. In house property, you can have LOP and SOP. We'll talk about the new scheme, but right now I'm talking about the old scheme. At the end of this video, we'll talk also about the new scheme and what has changed there. You can have LOP, you can have SOP, you can set off with each other. Example, LOP is a profit of 3 lakh, SOP there's a loss of 2 lakh. Can I set it off? Yes. In PGBP, there are 3 heads of or 3 different types of businesses. One is called non-speculative business or called normal business. Yeshas Academy is a normal business. McDonald's is a normal business. Rameshwaram Cafe is a normal business. Netflix is a normal business. Then there is speculative business when I'm buying and selling shares, gold, etc. without taking delivery. That's called speculative. And there is a specified business where I've started a hospital, etc. You know it from PGBP. So you have to keep all of them separate and keep some gap while you're drawing the diagram. If it's non-speculative business, also normal business, and there is a loss there, example 6 lakh, you can set it off against specified business also, and you can set it off against speculative business also. But if there is a loss, same loss, example 5 lakh rupees here, then it's a unique blood. That means you cannot set it off even within the family. And same here, 3 lakh example is a loss, again unique blood, you cannot set it off even against specified business, no, because they are different, unique. Remember, in the exam, if they give you a derivatives loss, then that derivatives loss will be considered as a normal business loss. Remember, the shortcut derivatives are normal. I hope these normal shortcuts will help us in the exam. Then there is capital gain. In capital gain, there are two kinds of capital gain. One is long-term capital, one is short-term. Of course, here you have to focus on loss. So if there is a short-term capital loss, example 3 lakh, you can set it off against short-term also, long-term also, no restriction. But if it's a long-term capital loss, example 5 lakh, then again it cannot be set off even if there are profits, because it is unique blood. It can only be set off against long-term capital gain only. And last guys is IFOS. In IFOS, typical incomes include your interest income, dividend income, where there no loss. How it's no loss? Because interest generally there's no loss. Dividend, when you earn, there's only one deduction allowed, that is the interest that you pay on the shares if they've taken on a loan. So typically in IFOs there is no loss. If you have any casual loss, example, I go into a casino, I lost 10,000, 20,000 rupees in the casino, then the government does not participate in that loss. So any casual loss, casual income fully taxed, but casual loss the government does not appreciate, they ignore that casual loss. So the only loss that can happen here is that if you own and maintain race horses, I call them OM horses, then in that case, if your horse wins, that's money, income, it will go here. If your horse loses also, that will be a loss. This is the only loss here. Example 3 lakh rupees. Again, it has unique blood. So typically there are 4 unique blood groups. I'm summarizing them: speculative business, specified business, long-term capital loss, and OM horses. These 4 are the losses which are unique. That means they cannot be set off against any other income except themselves. Now let's go to the second step. If you still have a loss, keep focusing on the losses. Then you will go to outsiders. Salary does not have a loss, so it will not go to outsiders. House property loss is friendly. That means it can go into salary also. Yes, it can go to PGBP also, capital gain also, IFOS also. It can go anywhere. It is friendly, but it is shy. That means you can only go up to 2 lakh rupees aggregate. That means either 2 lakh here or 2 lakh here or 2 lakh here or 2 lakh here, or 1 lakh here and 1 lakh here also is okay, but not more than 2 lakh rupees in the year. So what if I have a loss of 2 lakh 20? Then only 2 lakh can go outside. 20,000 will be carried forward. That's for house property. Next, PGBP can also go to any 4 neighbors except salary. PGBP does not talk to salaries, so it's semi-friendly. It does not go to salaries. It can go to house property, capital gain, even IFOS. Yes, even IFOS. Next, this is also done. Capital gain is non-friendly. They say, I'm not talking to anyone else. I don't knock on anyone's door, so that loss will never go outside to any other head of income. And IFOS, there is only one loss, OM horses, which is unique, so it cannot go outside. Unique blood, the deal is with unique blood is they do not go outside as well. Guys, this is the concept. This is called inter-head adjustment. You can quote section 71 here. And now whatever loss remains, of course, salaries, there is no loss remaining. But in case house property losses remain, you can carry it forward for the next 8 years. Generally, it's for 8 years. But remember, if you carry forward the loss, then the next year, that loss will only be under house property only. That means if I have a loss of 2 lakh 20, I've set off this year 2 lakh, 20,000 is carried forward. So next year 20,000 can only be set off within house property. It cannot go out. It gets a stamp called quarantine stamp. Remember, any carry forward gets a stamp called quarantine stamp. Same with PGBP. It can be carried forward for 8 years, quarantine stamp. But speculative business, because it has speculation, only 4 years it will be alive. And specified business can be carried forward indefinitely. Capital gain again 8 years. IFOS, any loss, OM horses 4 years, because OM horses and speculative business have an element of speculation. Hence the government says only 4 years we will allow that loss to be carried forward. This is the concept of inter-head adjustment and then carry forward. So remember, carry forwards, generally if it's in the 8th year, then you will, after this year it will lapse, so it will not be carried forward to the next years. Remember 8 years, remember indefinitely. Now that all 3 steps, first is intra-head is over, next is inter-head is over, next is carry forward is over. Let's talk about some unique points. First, if I have discontinued my business, example, I had a business, shoe business, which I discontinued, and next year I started a business of selling laptops. Can I adjust the shoe business profit against loss against this business profit? Yes, you can. As long as the person is the same, even discontinued business losses can be set off, but of course only for the next 8 years. Or for whatever is the life of the loss. Basically, generally for 8 years. If it's speculative, then obviously 4 years. Next, The government says, listen, I'm allowing you to carry forward your losses for 8 years, 4 years, etc. But you need to do me a favor. You need to file your return of income, also called ITR, by the due date of July, October, and November. If you file your due date as per July, October, November, then great, I will allow you to carry forward that loss. But in case you have a loss and you don't file your return on time, that means by June, then that year's loss will not be allowed to be carried forward. Example, if this year I don't file my return on time, this year's loss cannot be carried forward. What about last year's loss which I'm carrying forward? Then that can be carried forward, because only the year you filed the return late, that year's loss is not allowed to be carried forward. Set off you can do, carry forward you cannot do. That's the second point. Third point, any casual loss. Example, loss from card game, very common in the exam. Please ignore that. First, don't have any loss in that. And in real life, in the exam, if they give you a loss, please ignore it. Loss from card game, loss from betting, etc. Ignore it. Fourth, when you have exempt income like agriculture income, like share of profit from a partnership firm, the government ignores that profit. They don't tax you on that. So same way, when you have a loss, you have to also ignore it. That loss from exempt activity cannot be carried forward. So basically, it has to be ignored. Next, if I'm very hungry and there are 3 dishes in front of me, will I eat all the 3? Yes. But if I'm not very hungry and there are 3 dishes in my fridge, then which one will I eat? The one that expires first. Same way here also, if the profits are limited, if you have limited profits, then how will you adjust those profits against the losses? First, it will be current year loss, any current year expense or current year loss. Second, it will be any brought forward loss, but which has an expiry. Example, which is the 6th year, 7th year, 5th year, 4th year, that kind of expiry. And third, you will minus UAD, SRE, and FP. I've forgotten to tell you about that, so let's recap. UAD, SRE, and FP. We'll come to this point again after a while. Now, what is UAD, SRE, and FP? UAD is unabsorbed depreciation. The depreciation I can't minus this year. That's called unabsorbed depreciation. That will be carried forward to the next year. It can be carried forward indefinitely. Yes. Whenever you carry forward, generally get a quarantine stamp. But for unabsorbed depreciation, there's a shortcut called IQ. They can be carried forward I for indefinitely. And second, they don't get a quarantine stamp. That means your unabsorbed depreciation can be set off against any head except salary. Let's take an example. Unabsorbed depreciation, 20. Can it be carried forward? Second year, third year, fourth year? Yes. And to any head of income? Yes, to any head of income. Same with SRE and same with FP, family planning expenditures. All three get a shortcut called IQ. Now coming back to this, if my profits are 100, first I will minus current year loss, example 40. Then I will minus brought forward losses, example 40. And only 20 will be minused from this. If there's anything balanced, it will be carried forward. This is the order of setup. Also remember guys, casual income, if you get lucky on a casual amount, then the government wants to get lucky on the full amount. There you don't get any deductions, you cannot set off any losses. This is the chapter. Let's see if we don't focus so much on the sections here. Additional points, non-friendly, 1 year, yes. Now talk about the default tax regime. In default tax regime, what has changed, sir? I'll tell you, not much. For salary, of course, there's no change. In house property, you cannot minus any SOP interest. So SOP will not have a loss first. Second, there are 3 changes basically. First, SOP will not have a loss. Second, in case there is a house property loss, you cannot go to outsiders for 2 lakh. No, that is changed. It's become non-friendly in the new scheme. So in the exam, they say default tax regime, then you cannot go outside. And in the old regime, you can go outside up to 2 lakhs. So first, SOP interest cannot be minus. Second, house property loss, you cannot go outside. And third, you cannot carry it forward. That means in the old regime, how you could carry it forward for 8 years, house property loss I'm talking about. Here, you cannot carry forward. It's a 1 year game. That's a shortcut. So these are 3 major changes in the default tax regime. This is a revision video. It's taken us about 11 minutes. Once you finish this revision video, focus on your chapter sums, because again, another practical question in the exam can be expected from set off and carry forward of losses. Over to the next video soon. Check, and we're back. This is the next revision video. This is a revision video part 2. And in this, we are covering those chapters which are very important and which we need to do for the exams. That means we're covering all the chapters. Yes, you heard it right. So whichever chapter you want to revise, use this revision video to revise them. I'm going to give you a lot of shortcuts. I'm going to refer to this quick book which you can get access to. I'm going to show you where to do the sums, how to prepare for the May 26. Of course, you can also watch these videos for September 26 and also for Jan 27 exams, but only for revision purposes. You should have ideally studied at some class or some faculty, or you should have taken either my classes, and you should have first done the entire understanding of the chapter, and you can revise using these videos very, very easily. So it doesn't matter where you studied, revise it from these videos. So today's topic is something that many people find a little tricky, but we'll try and simplify it. And this is the next chapter, which is capital gains. Okay, so for capital gain, first I will tell you a brief outlook and then we'll go into the details. First, in the exam, they will tell you an asset. Basically, there are 5 letters to it: A, T, P, S, E. A basically means asset, so there should be 1 minute. Yes. A basically is the asset. So in the exam, they will give you some asset. Example, a person is selling his land, gold, etc. There will be some asset. Don't worry about the definition of asset, not important. Just remember, any SPL, any stock is not taxed under capital gain, it is taxed under PGBP. Any personal movable property is also taxed, not taxed unless it is in the form of jewelry, etc. And any rural agriculture land is not taxed under capital gain. So that is asset. Next, it should be sold. Sold basically means either you are selling it or the government is buying it, compulsory acquisition, or there is a barter exchange, or there is extinguishment. Somewhere or the other, there should be transfer. Transfer means getting rid of. P is period of holding. Guys, remember, for your exam, that is the financial year or the previous year is 25-26. The government made a huge change on the 23rd of July 2024, and your exam is after that. So only focus on post that amendments, because ICI in the material also have said that only post that will be important. So for that, period of holding is 2. If you hold an asset for more than 2 years, it becomes long term. And for certain assets, if you hold them for more than 1 year, what are the certain assets? Listed Zoom. Any listed share, 1 year. Any zero coupon bond, 1 year. Any units of UTI or units of equity oriented mutual fund, also 1 year. Equity oriented mutual fund means those mutual funds where the main focus is on equity. Next, S. Whatever you're selling is the selling price. You will write, example, I bought a house for 20 lakh rupees. I'm selling it for 1 crore. So my selling price is 1 crore rupees. And C is the cost. Whatever I purchase is the cost. This is a brief framework. Now let's go into details. A is not important. Skip it. T is not important. Skip it. Period of holding you already know. Now S. Now, whenever you're selling the sale consideration, the government says, listen, we don't trust you in 4 cases called buds. So let's go ahead and let's talk about the buds part. All this is not important. Let's go to buds. They say that in 4 cases, we don't trust you. I'll just revise it here only and then we can refer it to the book. If you're selling a land and building, if you're selling unlisted shares, if you can't determine the value of sale, or if it's a slum sale, in these 4 cases, we will take whatever value you are saying, example 100, and we will compare to the fair market value, example 130, and we'll take whichever is higher. So the government here, only in these 4 cases. But in case of land and building, they've given you a 10% margin. They say that we will compare your price plus 10%, so that is 110 with 130. And if you are still 130 still higher, we'll have to take that. What if this is 108? Then your 10% is matching it, so they will believe you and they will consider your 100. So this is it. And in case of land and building, they don't use fair market value. They use a concept of stamp duty value. Remember, stamp duty value, in case there are more than one stamp duty values, date of agreement, date of registration, then you can take the date of agreement lower stamp duty value, provided that you have received some money. Yes, because you're selling an asset, you have received some money by modes other than CBC. Okay, let's move ahead now. So now it's the time of cost. There are 2 kinds of cost. When you buy an asset, it's called cost of acquisition. When you put some capital expenses to it, it's called cost of improvement. Example, I bought a land, cost of acquisition. I put a fence around it, cost of improvement. I bought a house, cost of acquisition. I put another floor on it, cost of improvement. So these are basically the 2 costs that you have to keep in mind. Now let's move ahead. In case of cost, there are some special costs. Example, for bonus shares, the cost is always 0. If an asset has been bought before 1/4/2001, in case an asset has been bought before 1/4/2001, it's old-fashioned. Basically means you can take the original cost or you can take the fair market value, whichever is higher. Example, your grandmother bought some gold before 2001. In that case, original cost, let's say, is 5 lakh rupees. Fair market value is on 1/4/2001 is 7 lakh. You can take whichever is higher. So we'll take 7 lakh. But in this case, if it's a land and building or land and building, then in that case, there is a ceiling of stamp duty value. So same thing, old-fashioned value, original cost 5 lakh, fair market value 7 lakh, and stamp duty value 6.5 lakh. So you limit it to 6.5 lakhs. That's one more special cost. So bonus shares we understood. Anything old-fashioned we understood. Next, let's look at some special costs. Alright, so this is the old-fashioned. In case you're getting some right shares, whatever you pay for right shares are generally issued at a lower price. Example, if the market price is 1,000 rupees, I can get the right share for 600. So that becomes my price. If I sell those right shares and someone buys it for 100, For that person, the cost is 100 they paid to me and 600 they paying to the company, that is 700. Next, if it's any asset gifted by, let's say, my grandfather, if my grandfather bought a house for 20 lakh rupees, give it to me as a gift, that gift is not taxable. If I sell it, my cost will be the cost to my grandfather. On the other hand, if instead of my grandfather, some old neighbor gave me that house as a gift, which he bought at 20 lakh, I will be taxed on it at the current value, example 30 lakh. So when I sell it, my cost will be 30 lakh. Remember this. And another very important thing in cost is, if there is any intangible asset like goodwill, patent, copyright, trademark, etc., in the exam, your cost will always be zero unless you have purchased it. So tomorrow, if I purchase some patent, then I will have a purchase price. So these are the 5 letters ATPSC. Don't focus on all this, focus only on what I'm talking about right now. We'll go to these points also and additional points. Next, now that you know these 5 points, what to do with it is basically calculate your capital gain. And for that, I'll give you a small shortcut in the exam. When you get the capital gain sum, just write this, write sale consideration, write expenses on transfer. This is the first deduction. Then write net sale consideration, then write cost of acquisition, and write cost of improvement, and finally you will get your long-term or short-term capital gain. Sale consideration, first fill in the blank, compare it, take whichever is higher. Expense and transfer, you can minus that is brokerage, etc. Then you get to net sale consideration, then whatever is your cost of acquisition and whatever is your cost of improvement. Guys, there is no concept of indexation now. I'll tell you when will indexation apply in additional points. And finally, you get your number called long-term capital gain. So this is the concept, this is how you calculate. Now let's move ahead. So I have understood capital gain. Now, when I'm supposed to pay capital gain, are there some exemptions? Yes, that's the second part of the chapter called exemption. Let's talk about the exemption. They say that if you sell an asset and buy another matching asset or a similar mix of asset, then you will get an exemption. Example, if I'm selling my house property, of course, it has to be a long-term capital gain. That means if I made a gain, the property was sold for 1 crore, I've bought it at 20 lakh, my long-term capital gain is 80 lakh. The government says if you buy another house against it, I will give you this entire 80 lakh as an exemption. There's a series of section 54 onwards. In 54, you sold a house and you bought another house. You have to buy another house within 2 years. You can also buy it before 1 year or 2 years later. You need to buy within the timeline. You need to buy, or you can also construct a house within 3 years. Till that time, you cannot misuse the money or put that in a separate capital gain account. Also, the new house that you buy, you should not sell it within 3 years. That means it's a lock-in. What if I sell it within 3 years? Then whatever gain they got exempted earlier, they will tax you indirectly. And this is how you will move ahead. You can in fact even buy 2 houses, sell 1 house and buy 2 houses. I can buy 1 house for 40 lakh, another house for 40 lakh. Yes, I can buy, but that has a condition. The condition is that the house you are selling, the long-term capital gain should be only up to 2 crore. If it's up to 2 crore, the capital gain, then you can buy 2 houses. But if it's more than 2 crore capital gain, then the government says you are very rich, you made so much of gain, you can only take this exemption for 1 house. Here they have a limit now. The limit is, the exemption is 80 lakh. Great. You cannot take an exemption more than 10 crore. Example, if you sold a huge bungalow and you made a capital gain of 15 crore and you're buying another bungalow, the government says the exemption will be maximum 10 crores. That is section 54. Same thing is 54B, where you sold an agriculture land, of course urban agriculture land, because rural agriculture land there is no tax on sale. So you sold an urban agriculture land and you're buying another agriculture land that has to be the same. You have to buy it in 2 years. There is no construction in that case. All the other conditions remain the same. That is section 54B. Next, 54F. Here you're basically selling some asset other than house property. So can I sell my gold here? Yes, shares here, diamond here, land, any asset. But it has to be again long-term capital gain. And here also the government says, listen, we'll give you an exemption, but you have to buy another house. So here it is family assets and house. But here you have to be careful about one thing. In my example here, the gain was 80 lakh. So you were investing 80 lakh rupees. But in 54F, where you're selling your gold, shares, etc., you don't have to invest this 80 lakh. You have to invest the sale consideration or the net sale consideration. That means after brokerage, whatever is remaining, that you need to invest in 54F. Example, if my year consideration is 1 crore, I've sold my shares and my gain is 1 crore, I need to invest 1 crore in the house. Yes, if I do that, the entire 80 lakh will be exempt. But what if I don't invest 1 crore? What if I invest only, let's say, 60 lakhs? That means I've only invested 60%. So out of 80 lakh also, I will get only 60%. There's a shortcut here called CIN. Take your capital gain into the investment amount. Investment amount is 60 lakh. Into the net sale consideration was 1 crore. That is 100 lakhs. So you have to do this number, and of course you'll get the final exemption number. This is 48 lakhs. CIN, C for capital gain, I for investment, N for net sale consideration. This is only in section 54F. Next, these three sections are applicable to you and me, individuals, and to our families called HUF. And besides that, there are two other sections. One is 54D. In 54D, there is an industrial undertaking which has been demanded by the government called compulsory acquisition. There also the gain is exempted if you buy the next industrial undertaking within the next 3 years. Everything else remains the same. And there is 54EC, easy capital gain, whereby if you sold your house property or land, here are the two things you can sell, house property or land, and you can buy government bonds like NHAI, REC, Power Finance Corporation, couple of other bonds if you buy, then in that case you will get an exemption. But this is only up to 50 lakh. The bond you have to buy within 6 months, not a big timeline. You have to keep the bond locked in for 5 years. Here the period is slightly longer, and you don't have any capital gain account to put the money in. These are some of the sections for exemptions you have to keep in mind. Now the idea is that the combination has to be maintained: house for house, agricultural land for agricultural land, family assets for house, industrial undertaking for industrial undertaking, government has to be acquiring it, and last is land and building or house property for basic capital bonds. Now that the gain example, let's say my sale was 1 crore, my cost was 20 lakh of a house, 80 lakh was my capital gain, 70 lakh was exempted, 10 lakh. Now how will this be taxed? So there are some special rates in capital gains. No other chapter has some special rates except here. So capital gains has some very peculiar rates. I'll tell you about that. First they say that, oh, you've sold a house property, tell me if it's short term or long term. If it's short term, we have no benefit, you will add it to your other incomes and you will use your slab rates. But if it's long term, then we'll tax you only at 12.5%. So my shortcut is N125. But this, if it were not shares, if this was basically it was not house property but listed shares, then the government again will ask you the same question: are they short term or are they long term? In case they're short term, the government doesn't like it, so they'll be taxed at 20%. But if they're long term, then amazing, they will tax on the first 1,25,000. They will tax nothing, but provided they're listed shares, listed mutual funds. Listed basically means on which you have paid STT or CTV, and above that 1,25,000 they will tax you only at 12.5%. So this is the idea. These are the special rates in case of capital gain: N125 and 12, 20, 125. Were they different earlier? Yes, before 23rd July they were different, but don't focus on that. Focus only on this and you shall get your marks. Now that the three parts are over, let's talk about the additional points one by one. Let's talk about additional points. First, we'll talk about an additional point called slump sale. It's a good question, can come in the exam as well. In slump sale, what is the idea is that you're selling not just one asset, you're selling the entire undertaking. Example, if I have two departments, transport department, biscuit department, I'm selling my entire transport department. That's called slump sale, where you don't put individual values. In that case also, you will have a sale consideration. Take whatever is your sale consideration with the fair market value, take whichever is higher. Remember, buts, this is the S part. Next, if there are some expenses, you can minus that. Then there'll be some net sale consideration. From that, you minus your cost of acquisition and cost of improvement. But for an undertaking, what is my cost of acquisition? So it's not one asset, right? You're selling a lot of assets. So your cost of acquisition is basically your net worth. Now, what do you mean by net worth? You will take all your assets and you'll minus your liabilities. That's your net worth. But when you take assets, be careful. If they are depreciable assets, example, you're selling your trucks, you're selling your building, depreciate them, and only then the WDV should be there. If it's land, non-depreciable asset, then you will take the original cost. If you've revalued, example, you bought the land for 1 crore, revalued it 3 crore, remove the revaluation, bring it back to 1 crore, and you minus all the liabilities, and this is how you get your net worth. This concept is called slump sale. The section is section 50B. Important. Couple of things you should be able to understand, and you should be able to do 1-2 sums on slump sale. We've done that in the book as well. That's the first additional point. Second additional point is AJ cost. Let's talk about AJ cost. If you see something, a date like this, 31st January 2018 in the exam, and they are listed shares, the concept is LLP. In the exam, you'll see a sum with listed shares. You'll see that they are long term and they are bought before this date and sold after this date. This date was a landmark date when the government made a speech. So in that case, you need to calculate a new cost. The cost will change. It's two-step process. The first step you take higher and the second step you take lower. In the first step, you take the original cost. Example, I bought the original shares for, let's say, 1,000 rupees. So I'll put 1,000 and you take the new cost, which we don't know right now. For that, we'll go to the next line. You'll take the selling price of the shares and you'll take the fair market value as on 31st Jan 2018. Example, your selling price is 2000, your fair market value is 2800. What is the fair market value? These are listed shares, right? So on the stock market, the highest price on that day, and if it's mutual funds, then the NAV you will take. So this or this you will take, whichever is lower. So 2000 will come here, and 2000 and 1000, whichever is higher. So 2000 becomes your new cost. Why was this cost given? Why is it cost? Don't go into all that right now. Just remember, if in the exam you see this date and you see LLB listed shares, long term and bought before this date, sold after this date, then you calculate AJ cost. That's the second additional point. Next, third additional point. We'll talk about additional points one by one here. In this third additional point, depends, I'm selling my asset this year, but I'm selling it to my cousin, my house. So he's paying me over 5 years. The government says, no, we will always tax you in the year of transfer. So if you sold your house in the year 25-26, you will be taxed in 25-26 only. And it does not matter when you're getting the money, except a few cases. The first case, when the house gets, or when an asset gets extinguished, destroyed, etc., and you get insurance money, then they will tax you, but they will tax you in the year of receipt. That's the first case. Second, in case you have asset and that asset has been converted into stock. Example, I have a house, I have 2-3 houses that I made it into a real estate company. So then I will be taxed. When it is an asset, it will be taxed under capital gain. When it's stock, it will be taxed under PGBP, but I will be taxed only in the year of sale. And last, if there is any compulsory acquisition, example, my house got acquired by the government, then in that case, I can get initial compensation. Then I can go to the court and fight it. I can get enhanced compensation. Of course, I'll engage a lawyer for that. And I can also get interest because the government might pay me late. Interest goes under IFOS and you get a 50% standard deduction. And both these initial compensation, enhanced compensation will be taxed in the year of receipt. So year of receipt, year of sale, and year of receipt. Remember, in the initial compensation, you will minus your cost of that house. But in the enhanced compensation, you can only minus the legal expenses or the lawyer's cost, nothing else. So this is the concept till now. Let's move ahead to the next concept. Just one second. Okay. So this is the next additional concept. What else is there in additional concepts? Let me just think. Rates we've done, slum sale we've done. Yes. If you're selling an asset and someone pays you an advance, example, I'm selling my house today and someone gave me an advance of 10 lakh rupees. And if they don't pay me the final amount, I might forfeit it. That's the word. That's all, forfeit or cancel. This amount goes to IFOS and I'll be taxed immediately the year I forfeit it, because if I'm earning income, there should be tax. But if this happened before 2014, rare case in the exam, they might not ask you, but in case they ask you that the advance you received before 2014, example, I bought my house for 22 lakh rupees. I wanted to sell it for 1 crore rupees and he gave me an advance of 10 lakh rupees. This was an advance. This is before 2014. Then even if it's forfeited, the government doesn't tax you immediately. What the government says is, listen, we'll wait. You keep this 10 lakh with you right now. Whenever you sell this house again, this 1 crore deal got forfeited, cancelled. So whenever you sell this house again, that time we'll tax you. How? Your cost was 22 lakh. They will consider your cost as only 12 lakh because you already received 10 lakh. So your cost reduces, your gain will go high, and that's how. So remember the forfeiture point and remember the date 2014, 1st April 2014. If it's after that, straight IFOS. If it's before that, then you will do the second case. All right. Is there anything else? I'll tell you the important sections here. For capital gain, the section important one is 48 when you compute capital gain. If you're writing any of the costs, that's section 55. The forfeiture amount was section 51. The special rates, 12.5%, is section 112. And those special rates on listed shares, they are section 111A for short term and section 112A for long term. This is for listed shares, etc. All right. Any other important points, additional point? Indexation. Yes, let's talk about the elephant in the room, indexation. Now, what is indexation? I'll tell you. Literally, your father's salary and your salary cannot be compared, because that was many years back. They used to say, "Hamare zamane mein aisa hota tha." We can't, of course, compare it. But now what is happening is, if I bought a house for 20 lakh rupees and I'm selling it for 1 crore rupees, I bought the house 10 years back, that is 2015, I'm selling it in 2025. Now there's a huge time difference. And for that, the government said, we might give you indexation. This indexation basically means they'll take the cost and they'll stretch it like a chewing gum and make it today's value, present value. So that's the concept of indexation. Now, indexation applies only in 3 cases. First, are you an individual or a HUF? Okay. Next, are you selling a land and building? Okay. And is it a long-term capital asset? In that case, only and only you get indexation. Now, how will this work? Your long-term capital gain will still be 80 lakh. I bought it for 20 lakh, selling it for 1 crore. My long-term capital gain is 80 lakh. So in my total income, it will be 80 lakh. But when I'm calculating my tax liability, I have two options. First is this gain will be multiplied by 12.5% tax rate. That's the first option. Or second, it's called I-20, Hyundai I-20. What is I-20? They'll index the cost. So you'll have to do this calculation again with the index cost. Let's say my index cost is 75 lakh. So 75 lakh to 1 crore, what is the gain? 25 lakh, and that 25 lakh will be multiplied by 20% tax rate. That's right, that's a shortcut. I-20, Hyundai made a car, we made a shortcut out of it. So this is the concept. Indexation, which is only applicable if you're individually HUF, if you're selling a land and building, not residential property, any land and building, and the asset is a long-term capital asset. Anything else? Anything else? In case of these are exemptions done, 54, 51 done, slum sale done, buds done, special cost of assets done. Yes. A company goes into liquidation. Example, Kingfisher Airlines went under liquidation and I had shares worth 10 crores of Kingfisher Airlines. Now, when they give me something in exchange, let's say they give me a plane in exchange. Great. Then in that case, for Kingfisher Airlines, it's a transfer, but they will not be taxed. But for me, the shareholder, I'm getting a plane worth 12 crore rupees for shares which are worth 10 crore rupees. So I have a long-term capital gain of 2 crore. Will I be taxed on it? Definitely yes. And in this case, if Kingfisher Airlines has profit and they're closing down the company and giving me money, there's a concept of deemed dividend 222C. So let's say Kingfisher Airlines had profits worth 20 lakh. Then first I will be taxed under IFOS, that is 20 lakh. And the balance 1.8 crore will be taxed under capital gain. So I will still be taxed under it for 2 crore only, but in two different heads. All right. One more small additional point, buyback. Now, what is a buyback? I have shares of a company which are at 1000 rupees. They have agreed to buy it back for 1800 rupees. So that's a buyback. Now, what happens in a buyback? When I get 1800 rupees, this entire amount will be taxed under IFOS. But that's not right. No, my gain is only 800. But they say first we'll take it to IFOS and this we will give you as a capital loss. So this is the concept under capital gain. All this is done. In capital gain head, you won't get any deduction for STT and CTT. That is when you buy listed shares, etc. You don't get deduction for that. If you want deduction for that, you can take it under PGBP, but there you don't have any special tax rates. All right, so this is your chapter. Now, indexation, perfect. All right, before 23rd July, this concept honestly is not very important. So you can ignore it. If you want to do it, you can do it. Otherwise, you can ignore it. This is your revision on capital gain. Guys, capital gain in the exam is a practical chapter. That means they will give you a sum to solve. So if you just watch this video, there's no point. You have to solve a few sums. You have to make a table, computation of capital gain of Mr. AXYZ, ABC person, etc. And you have to solve it. You have to start with sale consideration. You have to get to the gain, and that's how you will get better at capital gain. 23 minutes of this video, ending it here. Let's see you in the next video.
Alright, and over to that chapter, which is going to be your first income in real life as well. Income from salaries. Honestly, it's not difficult. It's overhyped. I'll give you some simple ways to revise it. Let's start. In the exam, there will be some individual. Of course, only individuals can earn salary. No partnership firm, etc. can earn salary, and they will have a job in which they are earning salary. So you have to divide it into 6 parts: SAP and SEP. First up, there will be a standard deduction. If that person has opted for the default tax regime, then 75,000. If it's not opted for the default tax regime, then 50,000. If nothing is said, then it's default 75. Then if that person is a government employee and getting entertainment allowance, then he will get also or she will also get an entertainment allowance deduction. A, B, C, whichever is the lowest. A is whatever amount has been received. You'll get that as a deduction. B is 20% of salary, or C is 5,000 rupees is what you will get as a deduction. And if that person has paid professional tax, he will get a deduction. But even the default tax regime, you don't get these two, you only get standard deduction. We'll talk about the default tax regime later. Next, any monetary amounts that he gets will be taxed as salary. So the shortcut is any amount coming from the master to the slave or the employer to the employee will be taxable. Employer is master, slave is the employee. And so if you have basic salary, you have dinner's allowance, you have bonus, you have commission, whatever name they call it, just take it and keep adding it, keep adding it. Next, they will give you some allowances: traveling allowance, hostel allowance, this allowance, that allowance. What you do is there is a shortcut called HRA, can demotivate and hurt heartbeat. Remember this and let's move ahead. If it's HRA allowance, you add it and then you will get an exemption. Exemption is 1, 2, 3, whichever is lower. First is the amount that is received. Second is HRA. In HRA, of course, you're staying on rent. So the rent paid minus 10% of salary. And last, if it's the houses in Mumbai, etc., metro cities, Mumbai, Chennai, Calcutta, and Delhi, then 50% of the salary, otherwise 40%, whichever is the lowest, you will get it as an exemption from the HRA amount, and the final amount will be taxable. Next, for conveyance allowance, traveling allowance, daily allowance, helper allowance, uniform allowance, research allowance, tour and transfer allowance, whatever money you get, you first add it, and then whatever amount you spent out of it. Example, if you get 1 lakh you will add 60,000 you spend, 40,000 will become taxable. Remember, for conveyance allowance, whatever amount you spend, but when you go from your home to your office and back, that amount will not be considered as spent because that way obviously you have to go to office, so it's your expenditure. Next, if you get a hostel allowance for your children, children's hostel allowance, you will get a deduction of 300 rupees per month up to 2 children. So if they give you 3 children, then you can only take a deduction. You will add for 3 children allowance, but you will get an exemption only up to 2 children. For education, it is 100 rupees. For blind, deaf, it is 3,200 per month. For area-based allowance, example, if you work in a difficult area like a desert area or a tribal area or a Naxalite area, then you get some exemption that they'll tell you in the exam which is the area and what is the exemption. So you'll add the allowance and you'll minus the fixed amount. Heartbeat is fixed. And tour and transfer, sorry, this is transport sector employee. If you're a pilot, air hostess, truck driver, bus driver, etc., then whatever allowance you get for that transport sector employee, you will add that and you will get a deduction. A or B. A is amount received 70% of that, and B is 10,000 per month. Whichever is lower, you will get an exemption. So these are some of the allowances for which you get exemption. Besides this, if you get any other allowance, example medical allowance, you will add it, but you will not get any exemption. And next is perquisite. Perquisites are basically benefits like been given a car from your office, etc. All these perquisites you have to value it and then you have to add it. So let's talk about the perquisite value. This deduction section is standard deduction is 16IA. The entertainment is 16.2, otherwise 16.3. Remember, 16 is all good. SAP, we've done the S part, we've done the A part, and now we have to do the P part, that is perquisites. Perquisites, you have to keep asking yourself who has paid for it and who's enjoying it. The master has to pay for it and the employee should be enjoying it. So that's a perquisite. And let's take from easy perquisites first. Let's take clubhouse expenditure. You got a clubhouse membership, your employer is paying for it, 2 lakh rupees, 2 lakh will be added to your salary. Next, credit card, you have got the annual fees and the amounts the master is paying, that is also supposed to be a perquisite added. But if it's a business expense, example, you use your card to buy some printer for your office, then that is not a personal perquisite, it has to be personal. Next, if you're going for a holiday to Kashmir right now, Kashmir, you can go, yeah, it's safe. And if you go and you stay in a Taj hotel, then amount paid by the master will be considered as a perquisite. But if you work at Taj hotel and you're staying in the Taj, if you work for Taj hotel and staying in the Taj hotel, then they can manipulate their amount. So hence amount charged by similar hotels. Next is loan. If you take a loan up to 20,000 rupees, no problem. If you take a medical loan, no problem. Otherwise, if you take a loan that from your employer and a lower interest rate, example, employer charge you 2% interest rate on your car loan, but SBI is charging you 8%, that 6% benefit will be taxable. Remember to compare with SBI rates on the 1st of April of the year. Next, we'll talk about some easy ones first and then we'll go to the more complicated ones. Not complicated, the different ones. All right. We'll talk about domestic servant. If there's a domestic servant given to you, employer is paying the salary, then it will be taxed. Gas, electricity, water in your house, employer is paying the bill, then you will be taxed on that perquisite. But if you work with Tata Power and they are only supplying power, then you will not take the market value, you will take the cost to them. Next, furniture. Okay, we'll talk about now the slightly different ones. Let's talk about medical facility. If it's a medical facility in India, example, you're not well, it's not an allowance, it's a perquisite. What is the difference? Allowance means you get money, you can use it the way you want. Perquisite means it's a facility. So you're not well, they don't give you money, but they tell you go visit the doctor, we'll pay the fees. And if it's anything to do with private hospital, private doctor, private clinic, and the master pays for it, that's a perquisite, that is taxable. But in one case, it will not be taxable if you go to GMC hospital. What is GMC hospital? India's best hospital. I'll tell you why. G is government hospital. M is basically a hospital which is owned by the master. Reliance Hospital, you work at Reliance, and C is commission approved hospital. In that case, it will not be a perquisite. Medical facility outside India. You're not well and you have to go outside for treatment. So there is STT. You travel, you stay and you get treated. Stay, travel, treated. STT. That entire amount 3 lakh, 3 lakh, 3 lakh. Example 9 lakh your master paid, that will not be taxed. But for there are two conditions. It should be within RBI limits. If they are paid 9 lakhs and RBI limit is 8 lakh, that 1 lakh will become taxable. And the travel part, when you go abroad and travel, that will be exempted only if you are poor. That means your income is low. GTI up to 2 lakh rupees. Poor, of course, I've used in a loose term. Next, mobile assets. Guys, your company has a car, they've given it to you, and you want to use that car. If it's using the mobile asset of the employer, then three assets, even if you use for personal purpose, no problem. LMJ, laptop, mobile, and journals. But if other cases like motor car of the employer you use, 10% of the original cost will be added to your salary. If it's rented, if they've also rented the car and they've given you, the rent paid by them will be added to your salary. Now, a sale of that asset. Example, that car you really like, motor car, mobile assets. 1 minute, 1 minute. Where is the other mobile asset? This is use of mobile asset. There is one more sale of mobile asset. I'll discuss it anyways. In case of sale of mobile asset, yes, if sold. In case, let's say you like the motor car, you're leaving the company, you want to buy that motor car, so you'll have to calculate the WDV and then whatever price you're paying. Example, it's a BMW car, 60 lakh rupees. You have to get it to today's value WDV, and the WDV is at 30 lakh rupees, and you're buying it for 25. The 5 lakh will be a perquisite because you're getting a benefit. Now, how will you depreciate? The rates are different here. If it's a computer and an electronic device with memory, then 50% rate WDV. If it's a motor car, then 20% rate only for motor car. And for all of the other assets like bikes, any other thing, laptop, etc., it will be 50% for computers, etc. Sorry, motor cars 10%, any other 20%, any other asset 10%. I'll revise the rates if you're confused. The rates are any electronic device like laptops, etc. 50%, motor car 20%, and any other asset of the company you're buying, the rate will be 10%. 10% will be on SLM. And here there is no half year, full year, the completed year. So if the BMW car was used for 3 years and 4 months, then you will depreciate for 3 years. 3 years, 11 months, also 3 years. 4 years and 2 months, then also 4 years. So how many ever completed years? Next, lunch and refreshment. If you go to an office, obviously some of the bigger offices provide you snacks, tea, coffee. Eat that, and let the employer pay no tax. But if they give you lunch and dinner wine during the office hours, then up to 50 rupees there is no tax. But if the lunch and dinner is for 80 rupees, then that excess 30 will be taxable. Same if they don't give you lunch, but they give you lunch coupon, same concept here. But if it's beyond office hours, then the full thing will be taxable. There is no 50 limit. But if you're in a remote location, then who will give you food there? So they will provide the food. There's no limit of 50. Gifts. Guys, remember gifts for first taxable under IFOS. If it's gifts in relation to your business and profession, taxable under PGBP. But if it's gifts from your employer, example, EY decides to gift you on your birthday, up to 5,000, no problem. Above that, fully taxable. All right. Sweat equity shares. You got some ESOPs, employee stock option plan. When you work in startups, etc., they give you ESOPs at a very lower value. Example, you start working at Zepto, they give you a share at 100 rupees. When Zepto gets listed, the share value is 1000 rupees. So you're a benefit of 900 rupees. That 900 rupees, guys, will be taxable under your salary set. And when you finally sell it, that 1000 rupees share for 1300 rupees, so 300 will be taxed under capital gain. Next, LTC. Guys, your spouse and two children are going for a holiday, and this is not about the stay in Kashmir. This is about the travel from Bangalore to Kashmir. When you travel, the air ticket, the flight ticket, the railway ticket, the bus ticket, etc., for that the master pays. The government will first add it, but you will get an exemption under section 10(5), and this is called LTC exemption. It is given subject to conditions. The travel should be in India. The travel can be for up to two children. If the first child is a single child and then you get twins, then you all three children also. But if the first child is twins, then you stop, because for the third child you will not get this exemption. Your master can pay, but the exemption will only be for two children. Then it should be the shortest route possible. If it's train, etc., it has to be the deluxe class, first class. But if it's air flight, it has to be only economy class. That means if you go by business class and your master pays for business class, it will be added, but you will get exemption only for economy class. And this exemption you get twice in a block of 4 years. If you don't use this exemption, it can be carried forward to the next block. So the next block of 4 years, you'll get three exemption. But the carry forward can be only of one exemption, and it has to be used in the next blocks. That is 4 years, first year only. Any other benefit, guys, simple rule: if the master pays for it and you are enjoying the benefit, then it will become taxable. Now let's come to the one which are very important, or not very important, but they are slightly different. Education facility, let's talk about. Guys, education facility, not allowance. That means you are going for MBA, master paid for it, no problem. Your spouse is going for MBA, master paid for it, taxable. Your children are going to school, the fees is paid by the master, taxable. But if it's a school owned by your master or operated by the master, example Reliance School, then in that case, that will be the amount charged by neighboring schools, but you will get minus 1000 per month. Next, accommodation. Guys, you are staying in a house, but the house is provided to you by an employer. Then in that case, how will you value it? It will depend on the population. If it's a big city, then 10% of your salary. If it's a smaller city, 7.5. If it's the smallest town, then 5% of your salary. Here the salary definition is slightly different. Everywhere else, the salary definition is BDC. Basic salary, DNS, which is forming part of retirement, and commission, which is forming as a percentage. But here you will not take BDC, you will take everything. In salary, you will take all monetary salaries. In allowances, you will take taxable allowances. And in perquisites, you will not take any perquisites. So that's the definition of salary. SAP. In salary, you will not take POW. PF contribution areas and areas you will not take, and OD you will not take. So see the definition of accommodation salary. Only for accommodation, the salary definition is SAP. I'll repeat. Perquisites you will not take, allowances you will take only taxable, and salary you will take everything except POW. No PF, no areas, and no OD. All right. Next, if you if let's say they give you two houses, then how why are they giving you two houses? Sometimes on transfer, you're transferring from Bangalore to Delhi, then they'll give you two houses. Up to 90 days, they will take only one perquisite, which is the lower. After 90 days, they will take both perquisite value. And if they give you accommodation in a remote location, then they have to give it. So in that case, there is no perquisite. What if the accommodation is leased by the employer? Then whatever lease they are paying, or 10% of the salary, whichever is lower. Yes, whichever is lower is an exception here. Next, if you give you hotel accommodation, hotel is generally of 24 floors. Why am I saying this? It's either whatever they are paying or 24% of your salary, whichever is lower. And if they give you furniture along with that, then furniture is a movable asset, so 10% of the original cost, or if the rent paid, or if it's on rent, the furniture, then whatever the rent they are paying. This is accommodation. Accommodation, the only main thing is a salary definition. Do the salary definition well. And that 10% is depending on population. Earlier, the rates were different. Now it's 10, 7.5, and 5%. Next is motor car. Guys, you are having a car which is used only for office purpose, then there is no purpose. If it's only for personal purpose, then for the motor car, 10% of the original cost. For petrol and maintenance, whatever you are paying and the master pays you, all that is a perquisite. But what if it's some part for office, some part for personal use? Then you will check the car's capacity. If the car has a driver, always add 900 per month. If the car is a big car, then it will be 1800 with fuel and car. That is the perquisite per month of big car is 2400, small car is 1800. How I remember, a big car cost is 24 lakh and small car the cost is 18 lakhs. And if it's only car without the fuel etc., then divide by 3, 1800 becomes 600, 2400 divide by 3 is 800, but you have to take 900. That is how you have to remember. These are all the perquisites. Remember SAP and SEP, and you should be good to go. All this is not important, guys, especially guys, the retirement benefits. Here are all the retirement benefits. You can go through them, but honestly, one day before the exam to revise retirement benefits is going to be a pain. So I'll give you a shortcut. Any retirement benefit, example, leave salary, gratuity, pension, anything that is while you are working, if you get that money, it is taxable. Example, while I'm working, I've taken leave salary, taxable, fully taxable, yes. But after you retire, there are some exemptions you get, but honestly, very complicated exemptions and not asked in the exam. Even if it's asked for 1 2 marks, leave it, no problem. I'm telling you, because it will spoil your other chapters preparation. So this is basically what is your salary concept. Here we go. I'm ending this here. Now this video is over. You can look at the next videos. All the best. Do well. Okay, so you've done all the hard work and you've reached to the number called gross total income. The next number which you need to minus is deductions under chapter 6a, and this is what is going to be discussed in this revision video. So watch this video and revise with me deductions under chapter 6a. First shortcut. Already 5 heads of income, so you've got the 5 deductions. So this is the sixth one. That's why it's called deduction under chapter 6a. No, that's not the reason, but that's a shortcut. There are different series, all with start with section 80. And in this case, you have to remember that while you have gross total income, like example 10 lakh rupees, your deductions can never be more than 10 lakh. Or if it's 12 lakh, then can never be more than your gross total income. Also remember that there are certain incomes which against which there are no deductions allowed. Example, all your capital gains which are at special rates 12.5, 20, 12.5. Your casual income, which I call as CC income, casual income and capital gain. On those you cannot minus any deductions. So only on the other gross total income, which I call as available GTI, you can minus deductions. That is section 80A, A for aggregate. Next is 80C. C series we'll do last. The same way we study in the book, we will do 80D. D is for D series. The entire D series is applicable to you and me and to a family, which is HUF. The first one, 80D. You are scared because doctors charge a lot of fees, hospital charge a lot of money, so you take medical insurance. So if you take medical insurance for yourself, spouse or children, and you pay the premium, you will get a deduction up to 25,000. If any of these people are senior citizens, then 50,000 per annum. If you pay premium for your parents, then you will get a deduction for 25,000. If the parents are senior citizen and residents, then you will get deduction of 50,000 rupees per annum. Guys, any of these people, whether it's self, spouse, children, or parents, that's the definition of family here. If they are senior citizens and they don't have any medical insurance, then if you paid for their medical treatment also, you will get deduction, but within the limits of 25 and 50,000 only. Here you can pay lump sum premium also. Example, can I pay premium for 3 years? Yes, you can pay. But then you are divided by 4. Example, if I paid premium for 3 years, example 60,000 rupees, then 60,000 will be divided by 4 years, and that is the amount of deduction you will get. Unless the insurance policy has been taken on 1st April only, then 3 years will be 3 years. Another thing, if you take central government health scheme, will you get a deduction? Yes, it's basically central government medical insurance. You will get deduction for that as well. Remember, the insurance money does not have to be paid in cash. You can pay through check, Paytm karo, kuch bhi karo, but cash mat karo. But here, if you do preventive health checkup, example, you went for some medical test and you got some test done, you can take a deduction for that. Yes, that is allowed in cash. 5,000 is the limit shared between you, yourself, and your spouse and your parents. Everyone will share this 5,000 limit. First, whoever takes it, the remaining will be used by the remaining persons. And this 5,000 limit is overall within the limit of 25,000. Do a sum and you should be good to go here. Next, this 80D is available to residents as well as non-resident because it helps the economy. Next in the D series is 80DD, disabled and dependent. You are disabled, sorry, someone in your family is disabled and they are dependent on you. The government feels bad and they give you a standard deduction of 75,000 if the disability is severe than 1,25,000 per annum. As in this case, the family is same, self, spouse, children, parents, but here they also include siblings, so that's a good thing. And if there are two siblings or two people dependent on you, disabled and dependent, you will get 75 plus 75. Remember, severe disability means 80% or more. Disability does not help the economy, so this deduction is only given to residents. Next, 80 DDB, double dangerous bimari. Someone you in your family unfortunately have a dangerous disease, severe disease, specified disease like cancer, etc. We don't want to talk about them. But in case you spend hospitalization, medical expenses, the government gives you reduction, but maximum reduction will be only 40,000. If the person who is sick, not you, if the person who is sick is a senior citizen and is and a resident, then you will get deduction up to 1 lakh. So generally 40,000, but some cases 1 lakh as well. Let's say you spent 2 lakhs, so you will get deduction only of 40,000. Yes, so whichever is less. And after that, if you got some money from medical insurance or from your boss or employer, etc., that will be minus, and the final amount will be allowed to you as a deduction. Double dangerous bimari also is only applicable to residents because no bimari helps the economy, guys. So that is the case here. We move ahead to the E series. Now, the E series basically when you're taking loans, the government says if you take loans to buy an iPhone, getting married, go for holiday, we don't care. But if you take a loan to go for education, if you take a loan to buy a house, if you take a loan to buy a EV, then we will give you deductions under the E series. So, E series is all about taking a loan and paying interest, not the principal. On the interest amount, you will get deduction. Let's see the first one. Um, by the way, this E series is by shortcut is PI. It is only on payment basis, only to individuals and only for interest. ATE. E for education. You have taken education loan either for yourself, spouse, or your children. That's a family. Yes, that's a small family here. And on that loan, the loan can be from India. The education can be anywhere in the world, and you're paying interest. So 8 years from the time you first pay the interest, EMIs, you will get deduction of the interest. And this is applicable to residents, non-residents both, because when you take a loan and you pay interest, it helps the economy. So this is section 80E. Remember, the education can be anywhere, and this is very common, but it should be for self, spouse, and children only. When you take a loan, the loan should be from authorized sources only, like banks, financial institution, NBFCs. 80EE, easy EMI. This was basically when you took a house on loan. This was in the year 1617. That time, whenever you put pay interest, first take the deduction under house property, and then the excess deduction you could take here up to 50,000 rupees. But now there is easy EMI again, 80EEA. In that case, you've taken a house between 2019 to 2022. In this period, if you've taken a house and the house should be a small house, it should be a first house, it should be up to 45 lakh rupees only. And if you're paying interest, again, first take the deduction on the house property. If there is any extra interest that you have paid, example, you paid interest of 2 lakh 45, there you could only take 2 lakh in SOP, and the 45,000 you can take here. Here you can take up to 1 lakh 50,000. Again, there are some conditions. The loan should be from approved sources like banks, financial institutions, and the house should be a first house. It should be up to 45 lakh, etc. Next, 80 EEB, easy electric bike. You bought an EV, Tata Nexon, but EV. The government is happy. They say that if the EV has been bought between 2019 to 2023, then in that case, whenever you're paying the interest, you will get a deduction up to 1 lakh 50,000. Here also loan should be from approved sources only. That is the E series. We go to the next one, which is this G series. G basically means giving. You're giving away, you're generous, you're donating money. So that has different sections. The G series applies to everyone. Let's talk about the first one, 80G. G for generous or give. You're donating money. You went to Tirupati Trust, you donated money. You went to an NGO, you donated money. The government gets happy. They say if you donate money, other than cash, more than 10,000 cash is not allowed. You will get a deduction, but they have put them in 4 different categories. In the first category, those funds you will get full deduction. In the second category, half deduction, 50%. And the third and fourth categories, you will get only 100%, 50%, again 150%. So in the third and fourth is 100 and then 50%, but subject to a limit. So first you have to see which category. If in the exam they give you first two categories, no problem. Just take the number and either the full number or the half of it. You will get a deduction. But if it's the next two numbers, C and D, then you have to be careful. Then you have to do something called ATI. Example, if I donate to the third and fourth category, the government says, first take your ATI, adjusted total income. What is adjusted total income? You take the total income, available gross total income, and you minus all the deductions except ATG and you find out adjusted total income. Example, my gross total income is 10 lakh. All deductions are 7 lakhs. So balance is 3 lakh. That is my adjusted total income, ATI. And then 10% of that, that is 3 lakh into 10%, 30,000 is the limit of deduction. First will be taken care of by third category and then by the fourth category. If you have some sums, you can have a look at that. Here also cash more than 2,000 is not allowed. The four categories, how do you by heart it? The B category is basically drought. The C category is family Olympics, and the D category is give him money to create temples. And any other category will always be in the first category. That's how you remember it. ATGG is next. You've taken a house, you've taken on rent, and you are paying rent. If you are getting salary and HRA, then you will get HRA exemption. But if you're like me, self-employed, and you don't get salary, you don't get HRA exemption. For those people, 80GG deduction is always there. Ghar is a shortcut. You've taken a house on rent. The government says we'll calculate three numbers, and whichever is the lowest, we'll give you as a deduction under 80GG. First number is very simple, 5,000 per month. Second number is whatever rent you're paying minus 10% of ATI. Again, what is ATI? Same, you take the GTI, you minus all deductions except 80GG, and that is your ATI. So 10% of that, and the last number is 25% of ATI. Whichever is the lowest number, you'll get it as a deduction. Remember, if you've taken a house on rent, then in that same house, in the same city, you should not have a house in your name or your minor children's name or your HUF's name or your spouse's name. Next is 80GGA, give around. I want to donate money for scientific research. I'm a businessman. I will get deduction under PGBP. But if you donate and you don't have PGBP, let's say a salaried employee, then you will get a deduction under 80GGA. Here also up to 2,000 rupees is the limit. Above that in cash is not allowed. 80 give big and give chota. These are political donations. If you're giving political donations and you're a company, then big donations, GGB, that's a shortcut. Then you will get a deduction here. And even if you put an advertisement in a political magazine and souvenir, which you don't get a deduction under PGBP, you will get a deduction here. And 80GGC is give chota. Small donations, you get a deduction here. This is for anyone other than company. Remember, your political parties already have a lot of cash, so your cash limit is zero. That means anything you pay in cash will not be allowed as a deduction. Next is 80JJA, job, add. By the way, guys, if you create jobs in India, is it good for the economy? Yes. So this is applicable to everyone, resident and non-resident. The government says if you add jobs, then in the first year, example, you added 10 jobs. Then on that 10 job, whatever salary you paid, that you will get a deduction into PGBP plus 30% of that you will get a deduction here. Example, you paid 10 jobs, 1 crore salary, then an additional 30 lakh deduction you will get here. That is a great thing under 80JJA, but there are some conditions. First condition, the salary should not be paid in cash. Second condition, the job should not be very expensive jobs. They should be basic level jobs. The salary should be up to 25,000. Third, you should be contributing to the provident fund. They should be permanent employees. Fourth, you should basically be engaging them and employing them for 240 days in the year. In case of laugh industry, leather, apparel, and footwork, you should be engaging them for at least 150 days in a year. But let's say I employ someone today in the month of March, 14th of March, then how will I complete 240 days? Then in that case, you have to see the same people, see next year if they're completing 240 days. And if they do, then this year deduction will be pushed to the next year. Remember, 80JJA is a very important thing, and here salary includes everything except for provident fund contribution and retirement benefits. Next is quality book. You are an author, you are an individual, you written a nice book, on that you are earning royalty. The royalty income will go under IFOS or PGBP, and then you will get a deduction under 80QQB quality book of maximum 3 lakh rupees. This is only given to resident authors, and here there are some conditions. Step number 1, if you are earning royalty as a percentage, then the deduction will be limited only to 15%. You can earn more royalty, but the deduction will be up to 15% only. That's step number 1. Step number 2, you will get the deduction only of the royalty income earned in India plus royalty income earned abroad, which has been brought to India within 6 months. That's step number 2. Let's say step number 1, 15% royalty is 1 lakh 50. Step number 2 is 1 lakh 20. Whichever is low will go to step number 3. And whatever deductions you've already taken as an author under PGBP, that you will minus. So let's say 1 lakh 20 minus already taken a deduction of 20,000 in PGBP. So only 1 lakh will be given as a deduction under 80QQB. Next is 80RRB. Here again you have a patent and you're earning royalty. Here also that royalty income will first go to IFOS and PGBP. Then you can take a deduction under 80RRB up to 3 lakh only. Here also the same three conditions. First condition 15% no. That condition is not here. You will take the entire amount. Second condition, whatever is received in India, same condition. And third, whichever is lower minus whatever expense has already been minus under PGBP. Next, if you save money and you put the money in a savings account, the government gets happy, and when you earn the interest up to 10,000 rupees, that interest will first go to IFOS, and then up to 10,000 you will get a deduction under 80TTA, 10,000 annually. This is applicable only to people who are below 60 years and to our families, individual HUF, but individuals below 60 years. Because if you're a senior citizen, then you will get a deduction under 80TTB. Remember, TTA is only for savings account. Interest and FD will not qualify for this deduction. Only savings interest. Next, TTB. If you're a senior citizen that is 60 years or more, we have a special section called 80TTB for you. Here, your deduction is bigger and 50,000, and here it is for any interest, savings, FD, etc., recurring deposit. As long as it's from a bank or a post office, you will get this deduction. Next, there are certain deductions you will get only if you file your return on time. This is not important. 80U. Guys, remember disabled and dependent, that same section, if you yourself are disabled, not your family members, you yourself are disabled, and you will get a deduction, same 75, 1 lakh 25. So 80 DD is when others are dependent on you, 80U is when you yourself are disabled. Next, let's go to the 80C series. The C series, some people might find it tricky, so I have a shortcut here. You are making contribution to certain funds, and because of that you will get a deduction. Girls life now needs 5 ultra senior assets. So if you're contributing to Sukanya Samriddhi account for a girl child, if you're contributing towards life insurance for self, spouse and children up to certain limits, even abroad insurance, if you're contributing to NABARD bonds, if you're contributing to national savings certificate, if you're making a 5-year FD or more, if you're contributing to ULIPs, if you're contributing to senior citizen savings scheme or your annuity plan, then all these payments when you make, you will get a deduction under 80C. If you're investing in provident fund, recognized provident fund, statutory provident fund, any provident fund but not unrecognized. If you're contributing to some mutual fund, shares and debentures which have a lock-in. If you're buying a house and you are paying principal, yes, so the first time, not the interest on the loan, you're paying principal, or you're paying stamp duty and registration charges, you will get a deduction here. If you're buying national housing bonds, you'll get a deduction. And if you're paying your children's school fees, college fees, etc., not tuition fees, not donation, then up to 2 children, whatever fees you're paying for Indian education, you will get a deduction under 80C. Remember, here it is applicable to residents and non-residents both, because it is helpful for the economy. And this is under 80C, very common. Only for children, remember, stamp duty and registration also. But for house, the house should be ready. Any loan in this entire chapter should be from approved source. If the loan is taken from an uncle, family member, then you will not get this deduction. Sorry. Now here, this is 80C. Next is 80CCC. Care. You're contributing again, but to LIC's annuity plan, then you'll get a deduction here under 80CCC. And if you're contributing to a national pension scheme, which the government made at CCD, that's a shortcut, guys, and you will get a deduction under 80CCD1. Self contribution, you yourself are contributing, then you will get a deduction up to 10% of salary. If you're not salary, then up to 20% of your GTI, that's a limit. But guys, these three cases, 80C, 80CCC, and 80CCD1, all these three together have a limit of 1.5 lakhs only. So, sir, if I want a higher deduction, sorry, you can only get up to this. But for NPS, because the government wanted to encourage you, they made 80CCD1B. They said, we'll give you a one bigger benefit of 50,000 if you contribute to NPS. So, this is more than 1.5 lakh. You will still get 50,000 deduction if you contribute to NPS only. Here in NPS, they have made another account. NPS, there was an earlier another account. Now there's another account here. But doesn't matter, on NPS, if they write NPS, then you will get a deduction here. In NPS, contribution to tier 2, if they write tier 2, then it will be under 80C. If they write tier 1, generally it is tier 1 only. The moment you see NPS, it is 80CCD only. Now, what if your master is contributing? If your employer is contributing, then first it will be added to salary. Example, your employer contributed 2 lakh to your NPS account. That will be added to your salary because it's coming from your employer. And then you will get a deduction under 80CCD2. How much will you get a deduction? 10% of your salary. If you're in the old scheme, if you're in the new scheme, then 14% of your salary. Remember, none of these deductions you will get in the new scheme default tax regime except JAN. This three have a limit of 1,50,000. Next, there's a concept of Agniveer. If you want to become an Agniveer, the government pays you salary. You can be called to work in the army, and they have a fund for you called Agnipath Fund or Agniveer Fund. In that case, if you contribute to that fund, you are the country's champion and hero. CCH1, you will get a deduction. And if the master contributes, if it will be first to add it to your salary, master means employer, that is the government. It will first be added to your salary, and then you will get a deduction under 80 CCH2. This is the C series. I hope you understood this. Anything else? Anything else? Anything else? I think that's it. Withdrawal from NPS doesn't matter here. It's about putting in money and you get these deductions. Remember, this deduction is very, very simple. You'll go to gross total income. You'll write less deduction under 80C, 80D, 80G, minus it, and then write the final income outside, which is the total income. About 17 minutes of this very useful video on deductions under chapter 6A. Let's move on to the next video now. Okay, so there are chapters, and then there is this one chapter. Guys, they say that the lion is the king of the jungle, and just like that, this chapter is the king of direct tax. It stands tall, it gets you a lot of marks, compulsory question, almost always, not compulsory, but pure question, almost always at question number 2. It stands very, very firmly. The chapter's name is TDS, TCS, and Advanced Tax. How do we understand it? How do we learn it? I'm going to solve your problem through this revision video. First, let's talk about the easier part, which is advanced tax. Then we will go to TDS and then we will go to TCS. So we'll start with advanced tax and let's get done with advanced tax. Now, example, in my tax liability, I will assume based on last year that this time I have to pay a tax liability of 1 lakh rupees. I'm writing it here. This is my tax liability of 1 lakh rupees here. The government says some of that will has to be paid through TDS. So, example, 10,000 paid through TDS. Some of them had to be paid through TCS. Example, 10,000 paid through TCS. So the balance is still 80,000 rupees. Now, the next time I will talk to the government is when I file my return of income. But the government says, sorry, this number is too big. If this was number up to 10,000 rupees, you could have paid it with your return of income. But if your tax liability after TDS and after TCS is still more than 10,000 rupees, you need to pay this amount through advance tax. So first up, advance tax is not applicable to everyone. Calculate your tax liability. If your tax liability is more than 10,000 rupees, only then you have to pay it through advance tax. Now, okay, so advance tax, when is it applicable? You understood. How do I pay my advance tax? The government says just send demanded money. They say you need to pay this advance tax in 4 installments. First, you need to pay it on 15th June. Next installment on 15 September, next on 15 December, and next one on 15 March. That basically 4 dates during the previous year. So in the previous year only you need to pay this advance tax. You need to pay here 15%. Now let's take this number and we'll make an easier number. Example, it was 1,20,000, 10,000 in TDS, 10,000 in TCS. So balance is 1 lakh. You need to pay through advance tax. You need to pay 15% by 15 June. If you pay it, great. If you don't pay it, there's a shortfall on that. The government charges you interest. On every installment shortfall, they charge you interest at the rate of 1% into 3 months, 3 months, 3 months, and year 1 month only. This interest is under section 234C. Here you need to pay 45%, here you need to pay 75, and here 100%. What I mean by 45 is not 15 plus 45, 15 plus 30%. So here I will pay 15,000. Here I will pay 15 plus 30, that is 45,000. Here I will pay 30 more, that is 75,000. And here the government will get the entire 1 lakh rupees. This is advance tax installments. Any shortfall, multiply, take the shortfall, multiply by 1% into 3 months, 3 months, 3 months, and 1 month. That is the interest. This advance tax section is section 207. The 10,000 is 208 because 2 plus 8 is 10. And these 4 installments are 211. I'm just telling the sections also. So that's covered. 2 plus 1 is 4. So there are basically 4 installments. Now, there are 4 incomes on which you don't have to pay advance tax till you earn them, called A, B, C, D. If you have any dividend income, then you cannot guess when you will earn that dividend income. Same with casual income. Same with any new business or same with an asset sale, guys. In these 4 cases, when you earn these incomes, in case of dividend, when you receive it, only after that you will have to pay that advance tax liability. All right, so this is a concept of advance tax. If you're a senior citizen, then don't worry about advance tax. But if you're a senior citizen who does business, then please pay your advance tax. And for people who follow presumptive taxation, if you remember 44 AD, ADA, AE, presumptive taxation, then in that case, you have to pay the only one installment. That means you don't have to bother about 3, 4 installments. Only the last installment, pay your tax and get done with this. This is a concept of advance tax. So two small things here, because it's the first April, the year starts April, May, June. This is very, very new. So the government says, listen, yeah, I know you will not be able to pay exact 15%. So somewhere, even if you pay up to 12%, there will be a shortfall, yes, but we will not charge you interest. So that's called a relief here. And here it is 36%. So these two cases, only in the first two cases, you have a small relief of up to 12 and 36%. This is your concept of advance tax. How will a sum be asked in the exam? The sum will first be asked. They will give you a person called Mr. A and they will say first, does he have to pay any advance tax? Then second, they will say that he has not paid advance tax liability. So you'll have to calculate interest under section 234C. That is, C is for check. You have to check it 4 times. And guys, total advance tax I had to pay is 1 lakh. If I don't pay this total advance tax of 1 lakh overall, then third, 234B interest will apply. B is baad mein. So after the year ends, whatever example out of 1 lakh, I have only paid, let's say 70,000. Then the 30,000 on that, I will have to pay interest at 234B. Interest always 1% per month or part thereof. And this 30,000, let's say, I will pay it in June after the year ends. So March the year ends, April, May, June. So April, May, June, 3 months I'll have to pay interest under 234B. This is the concept of advance tax. In my Yeshas book and ICM material, there is one sum on advance tax. Try and finish it off. And once you do that, you will be okay with advance tax. 1, 2 sums and you should be good with advance tax. This is where advance tax concepts are written. Here we go. Jaldi se de do money, just send demanded money is the shortcut. June, September, December, March. Yes, advanced tax calculations, the installments you have to round off to the nearest 100. What I mean is, if let's say the amount of installment, if it's 1 lakh, 15% is 15,000. But let's say it was not 15,000, it was 15,820. Then you have to round it off to 15,800. Basically, that means the earlier 100 you have to take it to. If it's 16,990, you have to take 16,900. This is called advanced tax installment round off. 234C, 234B are the interest amounts. Now let's go to TCS and let's see what is in TCS. There are some small amendments also in TCS. Let's talk a little about that as well. Perfect. Now in TCS, there is a person in the exam also. You'll have to draw this diagram in rough work. There is a person who's a seller, and this seller is selling some things. And when he's selling something, of course, this is the buyer. Example, the seller is a BMW guy who's selling BMW cars, and the car is worth 80 lakh rupees. He's selling it. And whenever he sells, of course, he will collect this 80 lakh, but he will collect a little bit extra and he will pay that to the government, and that extra is called TCS. So TCS is basically collected by the seller. Always keep the seller in the middle and you'll get your idea. TCS is on sale of a few items also only. What are these few items? Alcohol scraps my car or scrapped my car. On sale of alcohol, on the sale of alcohol, on the sale of scrap, which is generated in the business, not the Raddiwala scrap. On the sale of minerals, there are three minerals: lignite, iron ore, coal, LIC. And on the sale of car, this is a fancy car, you have to collect 1%. So in these four cases, it is 1%. Two licenses. So when you're selling a license basically for a toll, when the government sells these licenses for tolls, mines, quarries, parking plazas, they need to collect 2% extra. If you're selling timber, trees, you cut the branches, you make timber. If you're selling timber, you need to collect 2% extra. This used to be 2.5. Now they amended it to 2%. And if you're selling tendu leaves, then you have to collect 5%. What is tendu leaf? That BD, I hope you don't smoke it, but that BD is made out of tendu leaf. So 5% in this case has to be collected and paid to the government. When should I pay to the government? If it's for the month of, let's say January, you have to pay it in February by 7th. If you pay late, then there will be, of course, some amount of interest you need to pay at the rate of 1%. If you collect and you don't pay, then 1.5%. That interest part is not so important. Now, this is TCS. Overall, anything more that you need to understand? Every for the month of every 7th of the next month you need to pay, but for the month of March you can pay by 30th April. These are some rates: lignite, iron ore, coal, etc. Yes, TCS is only on wholesale sale. Example, if I'm buying a bottle of beer, it's a Saturday, I want to buy a bottle of beer. On that there is no TCS, not on retail level, only on wholesale level. But only car is at the retail level. Now one big amendment has happened. Let's talk about that amendment. First, it was only fancy car 206C1F, that if you're selling a car which is more than 10 lakh rupees, on that car, bike, etc., there was TCS at the rate of 1%. Of course, not only at the retail level. RR, that is Rolls Royce car, that is shortcut, only at retail level. Only when you receive the money, you need to collect 1% extra. But now that has been extended. 206C1F is not just a fancy car, but it is a fancy person. When you're buying clothes or bag or a sunglass or a watch or a horse or a helicopter, about 10 lakh. Guys, you must have seen Patek Philippe and all. These watches are more than 10 lakh rupees. In case you're buying them, there's a seller who's collecting that money, will collect 1% extra and pay to the government. This is basically something that has been amended. So pay attention to this. Next is 206C1G. By the way, there is another section called 206C1H that has been removed, high value, so that you don't have to worry about. Now 206C1G, what is this? Global. That means there is a guy who's a seller and he's selling forex. Why is he selling foreign currency? Because he's selling it to you because you want to go for an overseas tour, you want to go to Dubai. No, now Dubai is being bombed. Let's say you want to go to Thailand, Singapore, Australia, all these countries. So you buy forex. So the government has said that, listen, this seller of forex, whenever you sell this forex, you need to collect some percent extra and pay to us under section 206C1G for global. Now, when will this be applicable? There are two cases. One is called liberalized remittance scheme. RBI has a scheme whereby you can send money abroad. That's called LRS scheme. In that case also this will trigger. And if you're going for overseas tour, in that case also, and if you're going for medical purpose, if you're sending money or education purpose. So there are 1, 2 and 3 purposes for which you're sending money. For general, if basically up to 10 lakh rupees if you send, there is no TCS. Above that it will be 5%. This is general purposes. If it's overseas tour, then guys, here for overseas tour to 10 lakh rupees is 5% and about 10 lakh will be 20%, because the government says, Habibi, why are you traveling abroad? If you want to go watch a beach, why are you going to Thailand? Go to Goa. If you want to, go somewhere else, then visit them in India only. So on overseas tour, this is the rate. General rate is basically 5% about 10 lakh rupees. But if it's on education with a loan, then in that case, the government has cancelled the TCS. So it is not there anymore. For other than if it's for education, sent for education, then no TCS. This is a big change. So these are big changes. There are two changes. One is the limit used to be 7 lakh. Now they made it 10 lakh. And for education, if you're taken money on a loan, then there is no TCS. This is the concept of TCS. Remember it. And now over to TDS. Alright, so now it's time for TDS, and in TDS again let's see one by one in the same order that we've done it in class. I'm going to revise it. First, in TDS, the middle person is not the seller, the middle person is the person who's paying. This is the payer. Let's say this is KBC, Kaun Banega Crorepati, Amitabh Bachchan, 7 crore, and he's paying a person who is Mr. A. Whenever he's paying some income to this person, Mr. A, the government says, listen, can you deduct a small amount and we'll call it TDS, and this is the government. So if in KBC, Amitabh Bachchan is literally sending you 10 lakh rupees, he will send you only 7 lakh rupees, and the 3 lakh, that is 30%, he will pay under TDS. The section for TDS are many. This one is section 194B, B for betting. In the exam also draw this kind of diagram, and life will be simpler. You'll get the answers easier. You need to know three things. One is the section, which is 194B. One is the rate, which is 30%, and one is the amount. In our example, the amount is 3 lakh rupees. Some common things, you need to pay this to the government by the 7th of the next month, which you already know. You need to give the PAN number of the person whom you're deducting of TDS from, because otherwise, how will he take credit? So you need to give the PAN number of that person. He can take credit. This person, Mr. A, can take credit because his tax has already gone to the government. You need to pay by the 7th of the next month, otherwise there will be interest of 1%. If you deduct when you don't pay, then interest at the rate of 1.5%. This all are common points, not important. Next, if there is other betting other than this horse race betting, then the section is 194BB, bigger betting. There was a section called 194O online that has now been removed. The next section is 194 N notes. So if you are a bank here, instead of KBC, there is a bank and you are withdrawing notes. The government says we don't have any problem with small withdrawals from the ATM, but if you withdraw more than 1 crore in the year, then there will be TDS in that case. So this is the TDS. I'm just reading out some of the sections here, which we've just finished. I'm just tick marking. 194B is done, 194BB is done. Oh, by the way, betting app, guys, all these Dream 11, of course, which have been banned right now, but in that case also there was TDS at the rate of 30%. So in all these cases it was 30%. But in case of 194BA, it was on the net amount. Example, if I put 10,000 rupees and I'm withdrawing 1 lakh rupees, on the 90,000 there was 30%. Next is 194, which was we discussing, 194N. Let's talk about 194N and notes. If you are withdrawing up to 1 crore, the government has no problem. But if you withdraw more than 1 crore rupees, then the government says, listen, collect TDS of 2%. They're telling the bank and pay to the government. This is 2% because the government wants to know who are these people who are withdrawing so much cash. This 194N does not apply if you're carrying a special bag. What is the shortcut bag? If you're the bank themselves, if you're an ATM service provider, and if you're the government, then this section does not apply to you. And if you've not filed your return in the last 3 years, you were supposed to file, but in all the 3 years you've not filed, the government is upset with you, and this rate becomes a different rate. Here, if you withdraw more than 20 lakh rupees, up to 20 lakh, nothing, above 20 lakh, 2%, above 1 crore, 5%. That is, higher amounts will be blocked, higher amounts will be deducted. This is the case. For cooperative banks, the limit is 3 crore. We go to the next one. There are some amendments also, change in rates. We'll talk about those as well as in when we discuss. Next is 194DA. I want to discuss death amount. You've taken a life insurance policy and you paid on death, you're getting the money back, no tax, no TDS. If all the premiums are low and you're getting the money back, no tax, no TDS. But if any of the premiums have been high, high means more than 10%, you know that from a chapter, different chapter, then in that case, whenever you get the money, there will be TDS. How will TDS be calculated? Step number one, the amount that you're receiving should be more than 1 lakh rupees. What if it's lower than that? Then it's taxable, but there will be no TDS. Second, you need to calculate the net amount. Example, the policy was for 10 lakh rupees. I have already paid in premium 7 lakh. So the net amount is only 3 lakh. On that 3 lakh, TDS will be at the rate of 2%. Earlier, this used to be at the rate of 5%. Alright, let's talk about the next one. But guys, remember, it's all the same. TDS, the best way to do TDS is do 2-3 after every chapter, do 2-3 sections. So by the time you finish 10-12 chapters, you would have finished about 30-36 TDS sections, which is not required also. We don't have so many TDS sections anyways. Next, if you're renting, I'm just going to talk about the main ones right now. If you're renting, the section is 194I. I for initially we rent. If you are paying rent, rent can be for land and building, plant and machinery, furniture, etc. Here there's an amendment. The rent should be more than 50,000 per month, that is 6 lakh per annum. Earlier this was a lower limit. Now only if you cross this limit, there will be TDS at the rate of 10%. But if it's plant and machine, then it will be 2%. Guys, remember, any of these people who don't give you the PAN number, then please deduct TDS at the higher rate, that is 20%. There will no TDS on GST amount. So example, if they're charging you rent plus GST, on the GST amount, don't deduct any TDS. If let's say if let's say the rent is that they're charging you is 10 lakh rupees plus GST, 1 lakh 80, 11 lakh 80, TDS will only be on the 10 lakh rupees, and no TDS on lump sum lease payments. If they're not giving you monthly, if you're not paying monthly lease payments, and if you made a lump sum lease payment, then in that case there is no TDS, that is 194I. Next is you bought an immovable property. Oh, by the way, this 194I does not apply to small individual. That means if you're an individual HUF and your last year's turnover is below the 1 crore limit in business and 50 lakh limit in profession, then 194I does not apply to you. Next is 194IA, immovable property you are acquiring. So everyone in life wants to acquire at least one house, one office, etc. So if you acquire an immovable property, 194IA, and the immovable property is more than 50 lakh rupees, I'll just show that section, and if the immovable property is more than 50 lakh rupees, then TDS at the rate of 1%. How do you remember that 1%? Everyone wants to buy at least one property. Now, what if the stamp duty value is 55 lakh and what is the sale consideration 65 lakh, then whichever is higher. And what if they are both less than 50 lakh, then no TDS. What if one of them is more than 50 lakh, then the TDS will apply on the higher amount. And this is 194IA. This applies to everyone. Next is 194C. If you are paying to a contractor, I see, I just saw C here, I saw yes. If you are paying to a contractor, example, some painter, some other person who's done some job work for you, to a contractor, when you're paying, there is TDS under section 194C, and that TDS is at the rate of 2%. But if you're paying to a person who's an individual HUF, then you will only block 1%, that is 194C. In contractor, or small individual, small HUF, don't worry about this section. If you are paying for personal purposes like painting your house wall, then in that case there is no TDS and small personal limit. And there's a limit of 30,000 only if you're paying more than 30,000, or overall if you're paying more than 1 lakh, only in that case there will be TDS. Perfect. Just 1 minute. Yes. I'm going to keep the video off for 5 minutes. Just keep listening to what I'm talking about. Next is 194C. This is done. You can study in more detail. This is contracts. On works contract, there is TDS, but on purchase, there is no TDS. If you are weak at TDS, guys, remember 2-3 sections at one go and you'll become more comfortable. Next, 194J. If you're paying to a professionals, jealous professionals, then in that case also there is TDS at the rate of 10%. But if you're paying for CMT, call center, a technical services or movie royalty, in that case TDS is only at the rate of 2%. What is professional? If you're paying to a CA, lawyer, PT, NRD, professional fees, technical fees, royalty, director's remuneration. For director's remuneration, there is no limit. For the others, there is a limit now of 50,000. Earlier, the limit was 30,000. Any other things here? That is 194J. Now, small individual, small HUF. Let's focus on those two people. If you're a small individual, small HUF, and if you are paying, then in that case, the government says, listen, there are two sections specifically applicable to small individuals. If you're renting and the rent is more than 50,000 a month, that means it's a big, beautiful house, immovable property. So section is 194IB. There will be TDS at the rate of 2%. Earlier, it used to be 5%. And if you're paying for to a contractor 194C, or to a jealous profession, or to a broker, then in that case, if you're paying more than 50 lakh in the year, only then it will applicable. These two sections, 194M is for misuse. This is only and only for small individuals, small HUF. Next, I forgot talking about these three sections. If you are paying to a broker, 194H, H for helper. If you are paying to an insurance guy, the commission, insurance brokerage, or if you are paying to a lottery guy, lottery commission. In all these three cases, only when the amount is more than 20,000. Earlier, this was a limit of 15,000. There is TCS at the rate of 2%. Earlier, this used to be 5%. So some changes here. You have to be careful about these changes. They are all in the quick book as well. Next is 192. Whenever you're paying salary, a lot of people get salaried. Just 1 second. All right. So in this case, 192, if you are paying salary, example, your EY, and you're paying salary to all your employees, then in that case, you will deduct TDS at the rate of average rate. That means you will calculate that person's salary, see what is the tax amount that you need to calculate, and divide by 12 is the amount of TDS you will deduct every month. That is TDS on salary. If that person does not give you PAN, here it is not 20%, it is maximum marginal rate. Next, if you withdraw from your provident fund account, your recognized provident fund account, within 5 years there is TDS. After 5 years, anyways, there is no tax, no TDS. But if you withdraw within 5 years, more than 50,000 rupees aggregate, then in that case, PF authorities will deduct TDS at the rate of 10%. That is 192A for Aram. How will you remember this? But PF pays you generally 10% interest. That's a shortcut here. Next is 192. Now the common sections. If you bought shares and the share company is paying you dividend, then it's 194. If you bought mutual fund and the mutual fund company is paying you interest, then it's 194K Kotak mutual fund. And here it's very similar. Or if the amount that they are paying you is more than 10,000, earlier it used to be 5,000. If it's more than 10,000, then TDS will apply at the rate of 10%. Very, very simple. Next, if you have bought debentures and the debentures companies are paying you interest, then section 193, again, same, more than 10,000, 10%. And mainly, if you put money in a bank, or if you have given money to a partnership firm, or if you've given money to a friend and they are paying you interest, that is 194A, A for Axis Bank. Then in that case, there will be TDS more than 10,000, 10%, but there are some exceptions. A small pub. What is a small pub? A is if it's motor accident claim tribunal, then up to 50,000. Example, in an accident, you had a court case and they are paying you interest, and that interest up to 50,000, there will be no TDS. Small pub, small individual, small HUF. When you are paying interest to some people, don't worry, don't deduct any TDS. Next, you. When you and me, we pay interest to banks because the banks are very few in the country, and so many of us pay interest to banks on home loans, car loans, etc. On that, we don't have to deduct any TDS. Banks, when banks pay us interest, this is a big change. For senior citizens, if banks are paying more than 1 lakh, and to the others, if banks are paying 50,000, then in that case there will be TDS. So the usual limit is 10,000, but for banks it is 50,000 and 1 lakh. So let's take an example. I have an account with HDFC Bank. They are paying me interest of 40,000, no TDS. 60,000, yes, there will be TDS. And all branches linked of one bank together. This is 194E, by the way, has been removed. 194P is pension. If you are someone who's 75 years or more, earning only pension income and interest income, only two incomes, and that too in the same bank account, then that bank, whenever they are paying you that money, they will not deduct TDS under 194A or etc. They will deduct TDS under 194P, P for pension. Based on average rates, they will calculate your average rates. And the best part is after 194P, you don't have to file a return of income as well. Some new sections. 194R, R for reels. Example, I am Samsung, I am Taj Hotels, I am giving some benefits to an influencer, some benefits in relation to their business and profession, like a free phone or a free night stay. Then if that amount is more than 20,000 rupees in a year, then there will be TDS. Example, I am Samsung, I am giving a fold phone to an influencer of 1,50,000. On that, there will be TDS because it's more than 20,000. And the TDS is 10%. How do you remember? Because you will scroll 10 reels a day. That's a shortcut. This does not again apply to small individual. Example, I'm a small baker and I'm selling some cupcakes, etc. as an to an influencer. In that case, TDS will not apply. And very, very new 194T. T is for trust. As a partnership firm, when you are paying salary and interest to the partners, you are in the middle, you're paying salary and interest to the partners more than 20,000, then there will be TDS again based at the rate of 10%. 194T for trust, T for 10%. These are the TDS sections. By heart them. Remember the 194S we forgot. If you are selling cryptocurrency, and there's someone who's buying it from you, so buyer in the middle, that person will be paying you the money. Example, if I am selling cryptocurrency for 1 crore rupees, there is a person who's buying it from me. That buyer will deduct TDS at the rate of 1%, 194S, only if the amount is more than 50,000. How do you remember this? Everyone wants to buy at least one cryptocurrency in their lifetime. This is not crypto only, this is any virtual digital asset. You can read this 194Q. By the way, is there 206C1H is not there, but Q is there. What is this Q? I'm a buyer, but I'm not a small buyer. I'm buying goods more than 50 lakh rupees from one person only. Example, I'm Chroma and I'm buying ACs from Daikin worth 60 lakh rupees. In that case, it's a quantity, Q for quantity. I'm buying more than 50 lakh. And last year, my turnover is more than 10 crore rupees. So I'm quantity in both ways, big in both ways. Then in that case, the excess amount above 50 lakh rupees. Example, in my case, 10 lakh of purchase, 60 lakh of purchase. So more than 50 lakh is 10 lakhs. On that 10 lakh, it will be at the rate of 0.1%. Yes, that's a very, very small rate under section 194Q. And in that Q case, if you don't give the PAN number, then the rate is not 20%, it is only 5% because 0.1 to 20 is too big. So 0.1 becomes 20%. Oh, sorry, becomes 5%. 194 LA, if you are not purchasing a property, but the government is acquiring a property, a change here also. Example, your land the government is acquiring and they are paying you. In that case, if they are paying you more than 10 lakh rupees, sorry, more than 5 lakh rupees, the TDS is at the rate of 10%. Earlier, this used to be a smaller number. Now the limit is 5 lakh rupees. The TDS is at the rate of 10%. Guys, remember TDS, the best way to tackle is it do 2, 3 at a time when you're discussing and you will understand it better. You'll be able to do this better. So ending this video here, this is a 25-minute video on TDS TCS. So we have seen TDS TCS advanced tax. We have a video on return of income. We have a video on rates of tax. We have a video on capital gain. We have a video on set off and carry forward. If there are any more videos that you require, let me know. Deductions also will be recorded and will be kept. So you have access to all these recordings. Okay, next is a tiny little chapter, but this tiny is chota bomb, bada dhamaka. That means a small bomb, but gives you good marks in the exam. This is a chapter called return of income, and in the next 10, 15, 20, 17, 18, doesn't matter the time, we will revise this chapter return of income very well. Also, guys, one of the last sums of DT paper will be a theoretical small theory question on chapter return of income. So do it well, and you can revise it using this video anytime you want. Let's talk about it first. What is return of income? See, just like when you give college exams at the end of the year, you get a report card. Same way, after the year ends, you have to tell the government what happened in the year. How many incomes, how much incomes did you get? What are your deductions? What is your final tax liability? How did you pay the tax? All of that you have to file by filing a return of income. It's also called ITR, income tax return. Some things you already know. There's a shortcut called John, which you already know, but we'll talk all about it right here in this return of income chapter. Let's talk about the section. The first one important section is section 139, which tells you who needs to file the return of income. First, we learn that. Then we'll understand when you need to file the return of income. Second is that. Then we'll also see that if I file my return of income late, what happens in that case? How late can I file it? Can I revise my returns? What is the like in an exam roll number you have? Like how do I file my return of income? All that we will learn. Let's start with the first one. Section is 139.1. Who needs to file the return of income? Now, here there are a couple of Lakshman Rekhas. If you cross any Lakshman Rekha, you better file a return of income. The first Lakshman Rekha is called compulsorily to file. So, if you're a company, C, or if you're a partnership firm, LLP, then doesn't matter what is your income, you need to compulsorily file. This is the first Lakshman Rekha. Second Lakshman Rekha, if your income is more than the basic exemption limit. But sir, which income? Total income, right? No, no, no. Here, the only place where gross total income should be more than your basic exemption limit. But your gross total income plus your 54 series exemptions. What I mean by that is, when I buy a house and sell a house, example, I have sold a house property. I have had a gain of 80 lakh rupees and then I bought another house property. So I got an exemption of this 80 lakh rupees. This exemption which you minus, you have to add it back. And then if that number is more than a basic exemption limit, you need to file a return of income. That's your second Lakshman Rekha. Third, if you like coffee, what is coffee? Of course, this is coffee. But what they're talking about here in coffee is if in your current account you have more than 1 crore deposit in the year, or outside India if you have any assets, including a partner in a partnership firm outside India, or if you spend on foreign travel for yourself or anyone else more than 2 lakhs in the year, or if your electricity expenses more than 1 lakh, the government says you need to file a return of income. So this is coffee. Only thing is outside India, oh, this is applicable only to ROR, because guys, if you are a non-resident, etc., you anyways will have assets outside India. So this O point is only applicable to ROR. Foreign asset basically means shares abroad, a house abroad, office abroad, financial interest abroad. But if you have money in the bank account up to 5 lakh rupees abroad together, then they will not consider that as asset abroad. Next, one more thing, there's one more Lakshman Rekha. So first Lakshman Rekha, second Lakshman Rekha, third Lakshman Rekha, and they added another Lakshman Rekha, and that is called Rule 12AB. In that case, business and profession save TDS. If in your business your turnover is more than 60 lakh, or in your profession your turnover is more than 10 lakh, or in your savings account you have more than 50 lakh rupees, or if someone has deducted TDS on your behalf, that means when while paying you some income they've deducted TDS of 25,000 rupees or more, and for senior citizen 50,000 rupees or more, then please file a return of income. These are 4 Lakshman Rekhas. Next, okay, I know now who needs to file the return of income, who doesn't need to file. But if I have to file it, by when should I file it? The answer is John. If you're a non-audit assessee, then 31st July. If you're subject to audit, then 31st October. And for international transactions, which we will see at CA final, it's 30th November. Next, my partnership firm is basically subject to audit. So my partnership firm's due date is October. I'm a partner in the partnership firm. I am not a big fish. I am not audit. Can I file it in July? They said no. Don't worry. If your partnership firm is filing its return in October, even all the partners, you all can also file it in October, because the partnership firm has to pay you salary, interest, etc. So you will have to wait for them to file the return so that you can file your return. So the shortcut is, if it's a big firm, then all the partners will also be considered as big. Next, loss return. Guys, if you make losses, like in capital gain, share market, you make a loss, business, you make a loss, then in that case, you need to file a return of income on time, because if you don't file a return of income on time, that loss will of that year will not be allowed to be carried forward, except two losses called HD. House property loss, and D is for depreciation, unabsorbed depreciation. These two you can carry forward even if you filed your return late. Next, that is lost return. Next, can I file my return belated? Yes, guys, you are running late almost always, even to class, even to a movie theater, hopefully not to your exam center and ICA exams. But the government says if you file your return late, you can do it, but you can do it not forever, but only up to 31st December. Example, your due date is June, July, October, or November. In all the three cases, you can file your return by 31st December. But if they assess you before that, then assessment. So if the government on their own they assess you, they check you, etc., then after that you cannot file this belated return. Belated basically means late return. Now if everyone can file the return late, everyone will file it late. So the government has said, but there are four repercussions called lift. First, there will be a late fee. This late fee will be 5,000 rupees per return. Yes, and this late fee can be reduced to 1,000 per return also if your income is up to 5 lakhs. So if your income is low, this late fee will become low. This is late fee under section 234F. Next, if you are supposed to pay the tax, you'll have to pay this tax along with interest under section 234A. That means after John, if you don't pay the government, of course, the government will charge you interest at the rate of 1% per month. And your losses, unfortunately, cannot be carried forward except HD, which we've already discussed. Next, I filed my return late. The consequences are here, late fees here. I filed my return late. Can I revise my return? The government says it's your return. You can revise it, change as many number of times, no problem, but up to 31st December only, or till assessment, whichever is earlier. There are no charges of revising a return. Go online, revise the return. If you've forgotten something, add, minus, etc. No problem at all. Interest under section 234A. 234A interest is basically after John, if you've still not filed your return and paid your taxes, interest under section 234A will become applicable. Next, bulk return, not important. Particulars to be filed along with return of income. Guys, in your return of income, the government does not expect much. But if you're supposed to maintain your books of accounts in PGBP, then your PNL, balance sheet, etc., you have to submit. But if you're someone who's got falling for presumptive taxation, where you don't have to file your return of income, in that case, sorry, where you don't have to maintain books of accounts, then you have to just give them details of your sales, details of your expenses, details of your profit, details of your tax. And of course, if you're subject to audit, like big fish in India subject to audit, if you remember section 44AB, then you have to also submit your audit report. If any of this is not submitted, then your return will be considered as defective. Okay, what is a defective return? Guys, sometimes what happens is you in the exam, you write the paper, give it to the examiner, and the examiner tells you, listen, roll number is not written. So same way when you file your return, the computer checks, the software checks at the government department, and if they find some mistakes, they send an email intimation saying that, listen, these are some of the defects, you please correct it. This is actually helpful. So the shortcut is 9 defects. You can correct it and reply back within 15 days with a corrected return, and they will be okay with it. And you can also ask for time extension, but if you don't correct the defects, it will be considered as an invalid return. Next, just like a check is valid only if you sign it, same way when you file a return, how does the government know that the real person has filed the return? So you need to authenticate it. You need to verify it. That's section 140. How do you verify it? You can do a digital signature. You can take a print offline and sign it and send it, or you can do an OTP verification also. There are many methods. That's not important, but who will verify? For an individual, the same individual. For HUF, the Karta, if he is not there, co-partners. For a partnership firm, managing partner. If he is not there, any other partner. For LLP, designated partner. If he is not there, any other partner. For a company, the managing director. If he is not there, any other director. Shareholder, no. Same way, like all the main persons can verify. And if the main person is not there and the others are also not there, you can give an authorized representative the authority to verify. Next, 139B, tax return preparers. Now, you are a doctor, you want to get your return filed, you go to a CA, but the CA is very busy or the CA is very expensive. So the government has kept some people as tax return preparers. They are basically qualified to file tax returns, and they can only do a very good job at filing tax returns, nothing else. So you go to them and they can help you file your tax returns, but they cannot file tax returns for some people, including if you're a big fish, that means you're subject to audit, then they cannot file your return. Next, if you're a non-resident, they cannot file your return. If you're not an Indian citizen, they cannot file your return. These are tax return preparers. Tax return preparers, who can be? Anyone. If you are more than 18 years, if you qualified some exams, if you give some exams of ICI, you can become a tax return preparer. That's perfectly all right. But tax return preparers, some people cannot be. Who are these people? Who are these people? Sorry. If you're already a CA, if you're already a lawyer, if you are a banker and you have a banking relationship with that person, and if you're an employee of a private company, then in that case you cannot be TRP. These are some people who cannot be tax return preparers. Also, if your original return was filed by a TRP, you can revise your return also filed by a TRP. But if your original return was filed by other than TRP, then a revised return also cannot be filed by the tax return preparer. When you write your exam, you write a roll number so that they know who is paper is that. Same way when you file your return, you need to basically give your PAN number. In fact, when you log into the income tax portal, your PAN number is your login ID. So you log in using your PAN number, and hence a PAN number is required to basically file your return. Now, any person who requires need to apply for a PAN, you cannot say I don't have a PAN number. You need to apply it. In all these cases, you can read these cases. You will have to have a PAN number. Even an assessing officer can allot your PAN number. And guys, PAN number has to be quoted in certain transactions. If you're buying a immovable property more than 10 lakh rupees, if you're buying certain jewelry, etc., more than 2 lakh, if you're buying a car, if you're buying any of these financial instruments like bonds, etc., more than 50,000, if you're paying to a hotel in cash more than 50,000, for foreign travel in cash more than 50,000, you can read this list. You need to quote your PAN number. Guys, this PAN can also become inoperational. We'll talk about that as well. Along with PAN, now you need your Aadhaar number also, and these both have to be linked. In fact, the government has made a section that if you don't link your PAN and Aadhaar, we will penalize you under a section called 234H, H for whom. In that case, they say that up to 2022, there was a fine of 500 rupees. After that, there's a fine of 1000 rupees if you don't link your PAN and your Aadhaar. Next, if you don't intimate your Aadhaar, your PAN will become inoperational. Inoperational basically means you will not be able to use your PAN. So please better apply and link your PAN and your Aadhaar. But let's say you did not link it, your PAN became inoperational, then you can link it and it will become operational within 30 days, but you'll have to pay a fee of 1000 rupees. When it becomes inoperational, what happens? You will not get interest for that period. If there is a refund, you will not get that refund. On that refund, you will not get interest. You will be TDS will be higher rates, TCS will be higher rates. These are some of the cases where PAN will become inoperational if PAN becomes inoperational. But this PAN becoming inoperational does not apply if you are in the cities of or if you are in the cases of JAM. For people who will live in Jammu and Kashmir, for people who live in Assam and who live in Meghalaya, for non-residents people, and for residents who are above 80 years, these people, this PAN operational thing or inoperational thing will not be impacted. Next, what is self-assessment tax? Guys, if I have to pay my tax, there are different ways of paying tax. Some tax I will pay through advance tax, some I'll pay through TDS, TCS, and the balance I'll pay through self-assessment tax. That is the tax you pay when you file your return of income. That's called self-assessment tax. Now, advance tax, we'll talk about these two things, 234B and 234C, in the chapter's revision video, TDS, TCS, advance tax, not right now. Very, very, very important. I have a feeling this will come in your exam. What is an updated return? I filed my return. After 31st December, I cannot revise my return, but after a year of filing my return, in the assessment year I filed, I realized I have made some mistake and I'm feeling guilty. Example, I have some extra income of 10 lakh which I didn't tell the government. Now I have no option. I can't revise my return also. How do I tell the government? So the government made an option that listen, you can update your return in after the assessment year. So your previous year is example 25-26. Your assessment year is 26-27. After 26-27, the government gives you 4 years to file an updated return. So if you want to confess something to the government, you have 4 years to file your updated return. But this updated return has some conditions. You can only file your updated return but if it increases your income, it ultimately increases your tax. You can file your updated return if it reduces your loss. Basically, you can only file updated return if it is for the benefit of the government. Then, sir, why will I file my updated return? So that if the government eventually catches you, you will have to pay a lot of penalty. Here, the penalties are not there. Here, they say that if you file your updated return, you have to pay some additional tax. That depends. Additional tax. Additional tax is 25% or 50% or 60% or 70% depending on when you file your updated return. In the first 12 months, 25%. After that 50%, after that 60. So the later you file updated return, the higher of additional tax you need to pay. But this is percent of what? This is percentage of your tax plus your interest. And remember, whenever you pay self-assessment tax, it has to be adjusted. How will it be adjusted? Example, I have to pay fees of 5,000. I have to pay interest of 10,000. I have to pay tax of 1 lakh rupees. This is what I need to pay. This is my fees. This is my interest. This is my tax. Now, if I have 1 lakh 15,000, then great. If I don't have 1 lakh 15,000, I have only 35,000. How will it be adjusted? First, they will take your fees, 5,000. How much remains? 30,000. Then they will take the interest out of it. How much remains? 20,000, and they will adjust the tax later. So tax still remains 80,000 on which they can still collect interest. So it's a very smart way. I call it the fit way. First fees, then interest, and then tax. Guys, this is your chapter. Pay attention to updated return. Pay attention to who needs to file your return. Pay attention to when can you file belated return. What are the repercussions? And these are some of the important questions that could be asked from the chapter return of income. About 15 minutes. This chapter is important. Over to the sums. Revise well. See you in the next video. So it's prediction time, and when, of course, revision video time also, but prediction time, because the first question will be about an individual, and the question will tell you to calculate total income, of course, which you will do with various heads of income deductions, and then they will tell you to calculate the tax. So we are revising a chapter called rates of tax. In the class, it was done in different parts, but we'll revise it together. First, rates of tax are different for different people. Like I and you are individuals, we pay separate rate of tax. HUF separate rate of tax. Partnership firm separate, company separate, but focus mainly should be on the individual. Like in life, we have many options: Swiggy, Zomato, Uber, Ola, Indigo, SpiceJet, or Air India. Depends whichever cheaper is what you opt for. Same way with an individual. If in the question in the exam they say that Mr. A wants to minimize his tax liability, then you'll have to find tax as per both, and then whichever is the lower one. In case they say that he has opted out of the default tax regime, that means the old regime. If they say he opted for the default tax regime, that means a new regime. If they are quiet about it, that means you need to follow the default tax regime, because there's default for a reason. So you have to see what is the scheme. People feel that only new rates of taxes are checked, but no, no, no. In the recent papers, Jan papers, etc., both old and new have been checked. So you should be prepared for both. Section 4 talks about the rates, doesn't matter. Tax is basically a basic tax where you will also sometimes check for rebate if the income is up to a particular level. Then, along with basic tax, there is surcharge also, and there is cess also. Cess means HEC. All right. What does surcharge mean? Surcharge is a rich person's problem. If you remember, surcharge is a tax on the basic tax. Health and education cess is basically 4% of your tax. So it's all looking back. Your basic tax is calculated on your income, your surcharge is calculated on your basic tax, and your HEC is calculated on your basic tax plus surcharge. In a nutshell, it's all looking back. Next, for individuals, up to 2,50,000, there is a base exemption limit. So in the exam, if the answer is up to 2,50,000, there will be no tax. From 2,50,000, more than that, up to 5 lakh is 5%. That is basically 12,500. From 5 lakh to 10 lakh at 20%, that is 1 lakh, and above that is 30%. Whatever is your income, whatever is the capacity to earn income, you will be taxed at 30%. This is basic tax. Always when you're checking, check for rebate, but remember, rebate is only given if you're a resident individual. If you're non-resident, sorry, we don't give you rebate. And in case of rebate, if you are earning up to 5 lakh rupees, you will get a rebate. 5 lakh, 10 rupees also you will not get rebate. It's only up to 5 lakh rupees there will be rebate under section 87A. Maximum rebate is 12,500. Next, if you're a senior citizen, the exam question says 60 years, 62 years, 65 years, 82, 85 years, 80 years, then 3 lakh and 5 lakh is the basic exemption limit change. Surcharge is the rich person's problem. If you earn more than 50, more than 1 crore, more than 2 crore, more than 5 crore, then there is a surcharge of 10, 15, 25, and 37%. Remember, surcharge, first calculate basic tax. Surcharge is a percentage of your basic tax. Next, this higher surcharge of 25 and 37% does not apply to those capital gain which are taxed at special rates. If you remember, 12.5%, etc., and the dividend income on that, the higher surcharge rates are not applicable. HEC is always like a best friend, consistent and always there, which is 4%. Non-resident, sorry, you all don't vote in India, so we will not give you a higher basic exemption limit. We'll give you basic exemption limit of 2,50,000, but not the higher exemption limit of 3 and 5 lakh. And sorry, we will not give you any rebate because you don't vote. Maximum marginal rate. In certain cases in TDS chapter, you will see that sometimes we have to use the maximum marginal rate, which is basically the highest rates, tax rate of 30%, surcharge of 37%, and cess of 4%. Remember, till now we are doing the old scheme. We will also look at the new scheme and those rates very, very soon. This rebate under section 87A, remember, if you are earning up to 5 lakh rupees, you will get a rebate, but the government says there is an income on which I am anyways taxing you less, listed shares, long-term capital gain, where the government says I'll anyways taxing you up to 1,25,000, nothing above that I'm taxing you only at 12.5%. So against that income, you cannot take rebate. So in the exam, if you have that income, separate the two incomes. Example, I have 2 lakh and 2 lakh. So separate this 2 lakh, separate the other 2 lakh. On the other 2 lakh, you can take rebate, but on this long-term capital gain of listed shares, you cannot take any rebate. HUF Hindu undivided family, it's a similar tax rate. Basic tax is the same. Of course, no rebate, and of course, no higher basic exemption limit because they don't vote. Surcharge is the same. So it's HUF is very similar to individuals, except two changes: no rebate, no higher basic exemption limit. Next, partnership firm and LLP, the government says, sorry, I have no mercy here, and you will, whatever is your income, you have to pay a flat rate of 30%. So 30%, there is no basic exemption limit, no slab rates. And if your income is more than 1 crore, then you have to pay a simple surcharge of 12%. HEC remains constant at 4%. Remember, while this is partnership firm paying the tax, when you get your share of profit from the partnership firm, you will not be taxed again because it is exempt under section 10(2)(a). Next is companies. Domestic company pay tax at 30%. Foreign companies pay tax at 35%. Here, foreign companies 35%. Here it is 30%. But this 30% for Indian companies can be dropped to 25% also. if 2 years back, example in your exam here, this changed just to 23-24. Your exam year is 25-26, so 2 years back that is 24-25. Not that before that 23-24. If in that year your turnover is up to 400 crores, then you will pay tax, basic tax only of 25%. Foreign companies are very lucky, the surcharge is very less. If it's above 1 crore your income, you will pay surcharge only of 2%, and if it's about 10 crore, then surcharge of 5%. And 2 and 5 is 7, so that's a domestic company, 7 and 12. Remember, companies, partnership firm, not important. Most important, individual, and then is HUF. Just remember these two. Next, what is marginal relief? If I was a student at CA Enter, mostly I would not do marginal relief because it's not important in the exam, but I'll still tell you. If you're somewhere at the border, India-Pakistan border, of course, you'll be worried that sometimes terrorists might attack, etc. Same way, if you're at the border of surcharge limit, example, your income is just slightly above 51 lakh. And in that case, thank you. Then in that case, you'll have to check for marginal relief. How do you check that? First, you take your income, example 51 lakh, you calculate the basic tax and you'll calculate the surcharge and you keep that ready. Then you go to the last surcharge limit, which is example 50 lakh. Again, you calculate the basic tax. Of course, there is no surcharge and you keep that also ready. And you see the difference in the income. The extra income is 1 lakh. And because of that example, if your extra tax after surcharge, not HEC, only after surcharge is 1,75,000, then the government says to earn this extra 1 lakh, you have paid extra tax of 1,75,000. So this 75,000 will be given to you as a relief. So this is a calculation which you might have to do, 0.01% chance you might have to do in the exam. But guys, I'll tell you when, how, they will never tell you margin relief. So how will you identify there's a question of margin relief? You are slightly above the last surcharge limit. So either you are somewhere in 50 to 51 lakh, 52 lakh, or just above 1 crore, just above 2 crore, or just above 5 crore. Next, tax rate for cooperative societies. Not important, but just telling you cooperative societies up to 10,000 rupees if you earn 10%. Up to 20,000 if you earn 10 and 20,000, that is 20%, and about 20,000, that is 30%. This is for cooperative societies, not important. Very, very important. If there is any undisclosed or unexplained income, unexplained assets, unexplained expenditure, then there is 115BB, big evaders, where you will have to pay a basic tax of 60% plus surcharge 25% and 4% cess. This is because you hid the income from the government. And against this income, you will not get any deductions, no adjustments, no basic exemption limit, nothing. This is important. Not really important if it's your 60th birthday on 1st April 2026, which is basically 26-27. Then you are saying that I'm a senior citizen next year, but the government says no. 1st April 2026 basically means one day before that, that is 31st March 2026, you're already a senior citizen one day before. So that's a good thing actually. For previous year 25-26 also you will qualify to be a senior citizen. If you don't understand this point, give it up guys, not important. If it comes in the exam, you can always calculate the date and you can calculate if the person is a senior citizen or not. Guys, this is our rates of tax till now. There are 1-2 additional points. Let me explain those 1-2 additional points. First, incomes of the previous year are generally taxed in the assessment year, but there are 5 such incomes called salad, which can be taxed in the previous year itself. This could be a good question. If you're a non-resident engaged in shipping business, then we might tax you in the previous year itself. If you're selling your assets to avoid paying tax, we might tax you in the previous year itself. If you're permanently leaving India, if you are a AOP BOI and you've been set up to establish or to have an event like a New Year party or Coldplay concert, or if you're discontinued your business, then in these cases, guys, we may, the word is may, tax you in the previous year itself. All right, so these are some of the additional points. There are some of the concepts here. One more concept you should know is round off, how to round off. We will discuss that ahead in the quick book also, is there in the earlier chapters. But I'll just tell you, round off happens at 2 places. First, when you're calculating total income, and then you're calculating your tax liability, final tax liability. Both the cases you have to round off. How I rounded off, if it's 13,35,661.2, decimal places you have to ignore and the last digit should be 0. If it's not 0, round it off. 66 up to below 5, guys, it will become 660. But if it's exactly 5, example here, or more than 5, then it will become 670. This is how you will round off. And the next round off you will do for your tax liability. This is your rates of tax. Now I'm going to go and finish my new rates of tax also here only. So I'm going to go to deductions. Here we go, computation of income, and we'll talk about the new rates of tax as well, or the new scheme as well. Guys, a new scheme, there's a section called 115 BAC. It's a better available choice. So it's a choice. You can choose the old one or you can choose the new one. In the exam, they will tell you which to choose. We already discussed that. It's also called the default tax regime. This is applicable to you and me, that is individuals, and to our families, that is HUF. In this case, what is the better things? Some very good things. Of course, this one, just one second. Yes, in better available choice, default tax regime, the slabs are now changed for the May exam. These are the slabs. Actually, the slabs have become easier. Up to 4 lakh, no tax. Keep multiplying the slab by 4, 4 to 8, 8 to 12, 12 to 16, 16 to 20, 24, up to 24 lakh rupees. They charge you only nil 5% and keep increasing the rates by 5%, nil 5, 10, 15, 20, 25, and about 24 lakhs only it is 30%. So remember, these slabs and the rates are new and they are even better to easier to remember also. No alternate minimum tax. What is this? We'll talk about it, but that is not there in the new regime if you choose the new regime. The new regime has a maximum surcharge of 25%. A 37% surcharge has been removed, so that is a good amendment. No impact on other incomes. That's also another amendment. You can choose the new scheme whenever you want. That means I can choose it till I file my return, except salaried persons have to select it earlier. Not important point. And also I can switch. If I have taken the old scheme, then I can move to the new scheme. Again, I can go to the old scheme unless I have PGBP. In case you have PGBP income, then you can enter into this new scheme, but you can't get out of it. Next, very, very important. Guys, if you remember, there was a rebate up to 5 lakh rupees in the old scheme. In the new scheme, this rebate was 7 lakh. Now it has been increased to 12 lakh rupees. That means up to 12 lakh rupees if your income is whatever tax you will calculate, but you will get a rebate or relief under section 87A. And sometimes if it's 12 lakh 10,000 also, same relief you will get here also. You will calculate on 12 lakh 10 first your basic tax. Then you will calculate on 12 lakh your basic tax. And the extra basic tax that you are going to pay, let's say the extra basic tax is 25,000. The extra income you want is 10,000. So this 15,000 will be given to you as a relief. This concept is here as well. Now that you've learned the advantages or the benefits of the new 115 BSc, let's talk about the negatives. In negatives, mainly the deductions which they used to give you. If you remember, you're offering income to the government, in turn they give you deductions. Those deductions we have to say goodbye to, farewell to those deductions. Let's go chapter wise, which deductions are not available. In IFOS, there is no deduction in case of family pension income. So family pension deduction, no deduction in case of family pension. No, sorry, this line is wrong. Let me correct it. Family pension deduction, it used to be 1/3 or 15,000. That has been increased to 1/3 or 25,000. That's one change. In capital gain, no change. In PGBP, now you only get all the deductions except these 5 deductions. No additional depreciation. You can take depreciation, but in the new scheme, if you want, then you won't get additional depreciation. You won't get scientific research when you donate outsiders. In house, you will still get. You will not get 35AD that also develops specified business 100% deduction. You will get depreciation though. You will not get 10A awesome media deduction, and these are some CA final deductions you will not get. So some deductions have been removed, other deductions continue as usual. Next, in salaries, you will not get any deduction except 1, 2, 3, 4, 5. For blind persons, you will still get 3,200 exemption. For conveyance, for tours and travels, you will still get these daily allowance, you will still get. Blind can still do tours. Blind can still do tours, and the standard deduction has been increased to 75,000. This is basically under the new regime. In house property, what is the change? Only one big change. Now in SOP, remember self-occupied property where you are staying in the own house, you and your family, and they used to give you interest deduction. Now, sorry, that interest deduction will not be allowed. That is one. And if you have a loss from house property, you earlier could go and set it off against other heads of income. That you cannot do. It has become non-friendly. Clubbing of income, remember your income, if you pass it to your spouse, son's wife, minor children, HUF, it will come back to you. But in this case, for minor children, you won't get exemption of that 1500 chiller amount that has been removed. Set off and carry forward of losses. If there is additional depreciation, you can't minus it, neither can you set it off, neither can you carry it forward. Same way, any expense which you cannot set it off, which you cannot minus, you cannot set off or carry forward. Chapter 6A deductions, everything has gone. Guys, all those 80D, 80 QQB, RRB, all of them gone out except JAN. What is the shortcut for JAN? If you have any JJA deduction, you will still get that. If you have any Agniveer scheme deduction, but not your contribution, your master's contribution, which is first added to your salary, that deduction you will get. And your NPS, National Pension Scheme, again, the 80CCD2 deduction, you will see this deduction still available. If you don't know these deductions, refer to the revision video of deductions chapter. This option can be exercised anytime, generally by filing the return due date. That time you need to exercise the option. A surcharge says even in this regime, same, no higher basic exemption limit. Remember here, the basic exemption limit is 4 lakh, whatever your age is. And rebate under section 87A is up to 12 lakh and maximum 60,000 rupees. Perfect. Now let's go to something called alternate minimum tax. What is this alternate minimum tax? First, let me explain, and then let me tell you why it's not important. The alternate minimum tax, first up, is only in the old regime. In the new regime, the government only realized it's a stupid mistake to have this kind of alternate minimum tax, so they removed it. So in the exam, if they give you the old regime, then you might have to look, very, very rare chances that you might have to see alternate minimum tax. If I was a student and things are troubling me, I would leave this, not important at all, but I'll still explain. Guys, if my electricity bill at home is 1000 and the Bescom department or the Tata Power or Adani Power department tells me to pay 1200 rupees, I have to pay it, but I'll get a credit of that 200. I can use it in the next bill. Same way, the government says first calculate your original tax. Then calculate your tax as per AMT, and if the original tax is, let's say, 1 lakh, but the alternate minimum tax is 1 lakh 40, you will have to pay 1 lakh 40. But don't worry, the extra 40,000 we will give you as a credit, which you can carry forward for the next 15 years. Next year, if your original amount is 1 lakh and if your alternate minimum tax is 80,000, then you can pay this 1 lakh. And while paying this 1 lakh, for the difference 20,000, you can use this credit. This is the credit. But sir, when do we calculate alternate minimum tax? I'll tell you, whenever you have these three deductions called SAD, any of them. If you have a specified business like a hospital, etc., where you get 100% deduction, or you have a 10A awesome area deduction, example, you went to SEZ and you have deductions for those 15 years, or you have some deductions like just JJA, RRB, QQB. In these cases of SAD deductions, the government will calculate AMT. How do you calculate AMT? First, you calculate original tax. That though you don't need help, you can always calculate original tax based on slab rates. Now, in this, you will take the total income. Example, your total income is 10 lakh. Then you will add whichever of these SAD deductions are there. Let's say you have a 10A deduction of 10 lakh. So you will add 10 lakh plus 10 lakh. So it becomes totally 20 lakh rupees. What they are doing is they are basically giving you a deduction first of SAD and then they are taking it back. On this adjusted total income, this income is called adjusted total income. They calculate first the alternate minimum tax. Alternate minimum tax will be at the rate of 18.5%. Yes, there are no slabs here. And then there will be surcharge and HEC as applicable. And finally, you'll get a number, which number, if it's more than your original cost, original tax, you'll have to pay this number. This is alternate minimum tax. It applies to everyone except companies. To companies, there is a concept called MAT, which you will do at CA final, not right now. Perfect, perfect, perfect. This, guys, is your chapter rates of tax. Now, when you finish rates of tax, what you do is you go to a couple of sums. You can take ICI papers. Every paper, the first sum has complete income and tax liability. Go to those papers, go to our books, go to the ICI material and solve for old scheme, new scheme, minimized tax liability. The more you do, the better it gets. This is 17.5 minutes of rates of tax revision video.